All right, everything looking good. We are live. Let's get this party started. Welcome back to the channel. Crypto Trend Trader with our midweek market update. It is 8 p.m. Eastern Standard Time on August 10th, 2022. And of course, as always, before we get started, I'd like to remind you this is not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. If somebody could just let me know we are coming through loud and clear and volume's good and everything, I would appreciate it. What's up, Jay Hoff? Good to see you, brother. Been a killer week. Let's kill it some more. Yeah, I mean, honestly, it's been, July was killer. August has been killer as well. So we're running on basically what amounts to about 6 weeks of just crushing these markets. So, look, got to be grateful. Okay. We sure do get lucky around here. All right. So let's jump right in and take a look. Obviously, the big news for today, we saw the markets rally quite a bit off of the inflation numbers. So we got our core inflation came out year over year, and that was forecast at 6.1%. Previous month was 5.9%, and we saw year over year it came in at 5.9%. So exactly the same as last month. So we don't have a month over month increase, but year over year, we don't have a year over year increase. Didn't drop or anything, but at least it didn't go up. So that is obviously interpreted by the market as good. And then for the inflation rate, year over year, and this is just the full on inflation, like not the core CPI. We have the actual came in at 8.5 with the forecast at 8.7 and the previous at 9.1. So once again, we hear everybody out here talking about inflation has peaked. Inflation has peaked. They will continue to call every single month the peak. But we're going to look at a chart that's going to basically reinforce or, let you guys know why I'm not so quick to call peaks and troughs. And you know what? I do it more often than I should. And part of it is just because obviously we get lucky a lot. So the confidence comes with the luck. But the truth is, shouldn't be calling tops and bottoms, especially not on like long-term trends. We're going to actually jump right into the charts. No effing around today and take a look. Also, we're going to go a little bit out of order today because we have a lot of member requests. So some nice setups too. So we're going to kind of jump over there and get those out of the way in the beginning. And then that way, if we're running too long later on, we can skip some of the stuff that we look at every stream. But I do want to make sure that we get all these in. So. All right, so I'm going to go ahead and pop up a little bit of that sweet, sweet Fred data. All right, so here we have, this is the sticky price, consumer price index, less food and energy. So it's similar to the core CPI. The difference is that this excludes some of the more like volatile short-term moves. So the sticky price, consumer price index CPI is calculated from a subset of goods and services included in the CPI that change price relatively frequently. Because these goods and services change price relatively infrequently, I'm sorry, I said frequently, but I meant infrequently. Change prices infrequently, they are thought to incorporate expectations about future inflation to a greater degree than prices that change on a more frequent basis. One possible explanation for sticky prices could be the costs firms incur when changing price. And obviously there's a million other reasons, that once inflation, starts, it can become entrenched, etc. So we're going to look here at, this is our, 1960s it goes back to, 1968 chart. So we're going to just pull this up here and just take a look at what's going on here. So, and I just want to make a very, very simple point with this chart. And I think it will help clear some stuff up, because right now everybody is like throwing around so many things all at once, and people aren't sure what matters and what's important. We're starting to develop like correlations, or people are starting to pick up on correlations, but they're not sure if it's correlation or causation. And it's just a lot of a confusion. And the majority of the people with the loudest microphones or megaphones or whatever you want to say, like, the biggest reach, literally have no idea what they're talking about. So it's just so much bad information getting picked up, regurgitated, and then just over and over and over again. But it seems like there's a lack of people with like an actual brain that functions, or like, maybe their brains function, but there's no like creativity left where people can come up with their own ideas. So it's just like this puking regurgitation of, the same ideas over and over again. So what I want to do is get to the actual bottom of some stuff and see like, hey, what could we expect? What's likely to happen? What's the difference between the causation and correlation? What's a, leading indicator as to what could be an issue, as opposed to, a lagging indicator, etc. So with that being said, what's up, Calma Betty? Good to see you. So with that being said, here we have the sticky CPI. And just for a heads up, it's not like majorly off or anything. Like the number that just came in for July, which was, reported today, obviously August 10th, was 5.629%, as opposed to the sticky, or the CPI rather, X food and energy, core CPI. That came in at, what was it, 6.1? No, was it 5.9? I can't even remember what I just said. I think it came in at 5.9. Yeah, so it was 5.9, and this is at 5.63. So it's slightly off, but not like massively or anything. And again, the reason I like it is it kind of just tunes out just a little bit of that noise and gives us just a slightly clearer picture, more useful picture, because there's not a bunch of other BS in there kind of clouding what we're seeing. So that being said, obviously food and energy are excluded from this also. So the fluctuations we're seeing in food and energy, obviously, everybody needs food and energy. Why do they exclude that? I get it. I get all that. But we got to look at the data that is important and that everybody else is using. And then we want to find a way to look at better data than everybody else is using, so that essentially we have an edge over everyone else. Because if everybody else is using the same data, we're just another one of the flock. But if we have an actual edge, that's where we can come out on top. And again, that's what we're going to do right now. We're going to point out a clear edge that's going to help everybody understand what's going on and interpret it. And then going into the future, let's just say I never come back on here and talk again. You're going to have an overall better idea as to what to expect. And then you're going to be able to use what you learn in the next 5 minutes to your advantage. I absolutely promise you that. And if not, you let me know at the end. So here we have obviously the 1968 to 2022 chart. So a nice wealth of knowledge. Obviously we see here every time it turns gray like this and it's highlighted like that, the back part here, I don't know how good it's showing up on screen, hopefully pretty clearly, but that is showing the recessions. So that is when we were in a recession. Now, the important thing to pay attention to is what we're looking at today is when a recession occurs, and then we're looking at when the CPI data, in this case, obviously sticky, X food and energy, we're looking for when the CPI data actually peaks in relation to when the recession starts, et cetera, et cetera, et cetera, all that good stuff. So we can see, hey, does one tell us when the other's going to happen? Does one always happen before the other happens? Does one have to, happen, but the other doesn't? So that's what we're looking for today. So in this chart right here, the most important thing right off the bat to pay attention to is, we have 3 massive spikes. One in 1970, we have one in 1970, like 4-ish, and then we have one in 1980. Those are all on the way up, putting in consistent. We have a high, then a low, then a higher low. A higher high, then a higher low, then a higher high. And then we have a higher low again, and then we put in a lower high. So this is an uptrend, obviously. So we're in an uptrend from the 1960s till we actually like peak out. Technically till we put in a lower high. So from, the 1960s, well, actually before that, but on this chart to the 1980s, we're in an uptrend. And then once we break down from here we have a high, then we have a low, then we have a lower high, then we have a lower low. So obviously now that's a downtrend for sure. But the most important thing now is we had an uptrend, then we got a downtrend, and then after that, what has happened since then, up until very, very recently, arguably you could say till right up in, September 2021. Well, it's very clear, obviously. We have a high here, then, assuming you just call that part of the move, or if you don't call that part of the move, we have a high, then a low, then a lower high, then a lower 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 low. Oh my gosh, what is that? It's a clear downtrend. And the downtrend went on from the 1980s until essentially that downtrend was still intact until somewhere in between 2010 and now. Obviously, this is going to be slightly different than some of our other trends. But here we finally put in this low right here, and then we put in a high, and then a higher low, and then a higher high, and then a higher low, and then a higher high, and then we break down again. But the most important thing is this is all just one move, right? Because now we have a low on the macro, then we have a high on the macro, then we have a low, and that's a higher low on the macro, and now here we have a higher high. So the same way that once we have 1, 2, 3, 4 points of reference, a high, then a higher high, a low, then a lower low, we can declare we have now officially entered into a downtrend based on that simple metric. Now, does that mean that we're in a bear market? Does that mean that we're going to go down for 30 years? Does that mean we're just in the middle of a correct? Depends on the time frame, depends on all that. But the most important thing to pay attention to is we're following the rules. So if we have the rules on the way up and this is a, bull trend or, upward market or whatever you want to call it, an uptrend, then here we have a downtrend or, a bear market essentially in inflation. So we have a bull market, a bear market, and now we have broken out of the bear market and confirmed into a bull market on the macro. And when I say on the macro, I mean, we have all these little moves inside of the one bigger move. But then once you break down, that's when the truth comes out. That's when the market reveals itself to you. Because if we break down from here and then we just go to a new lower low, it's like, oh, okay, see, it was a big fake out because we had these higher lows and higher highs, and then we still went to a lower low. But here, the market is being constructive. And when we came down in 2021, we put in a higher low, which is very important because then once we broke above our peak from 2020, now we have a higher high and a higher low. So now we have a clear uptrend. So we have broken out of the downtrend that went on from the 1980s till 2010. So a 30-year downtrend, we broke out of it based on, our CPI data, sticky, etc. You guys know. I'm not going to keep just saying it over and over again, but I'll assume that you know what I'm talking about. So that being said, now we have confirmed that we're in an uptrend. So what does that mean? Well, we don't know exactly what it means, but we know the last downtrend was 30 years. The uptrend before that was, just on this chart alone, assuming this was just the first data point ever in existence, and before that, Earth did not exist. From 1967 till 1980, arguably till 82 when we confirm that lower high. But in hindsight, we can say till 1980. So we have about, 13 years roughly. We have about 30 years roughly. So I would say that this chart right here might be one of the most important things that you could ever look at in your life. Because the truth is, the last downtrend was 30 years. The uptrend before that was, we'll just call it 15 for simplicity's sake. So if we're breaking out of the 30-year trend and we only have 2 data points, a 15-year trend and a 30 trend, let's just say, for instance, we just do the bare minimum and we go into a 15-year bull trend on, CPI, 15 years of inflation. Well, that's crazy. That'll never happen, blah, blah, blah. Well, I mean, are you sure? Are you sure? Because a lot could change. A lot could change. And we know that because in the beginning, we called for inflation going into all this, and we saw the inflation. And then we called for, some deflation or disinflation or deceleration of inflation. And the truth is, what actually happened was a bunch of policy errors came out over and over again, and that changed our base case from, hey, this is going to take a lot longer before we actually are able to crush this inflation, because they let it run so long. Jerome Powell sat there and enjoyed his birthday inflation blowjob so long that it became entrenched. So now it's entrenched and everyone expects that inflation to be part of their lives going into the future, a just steady increase all the time in prices. And of course, just worse and worse, standard of living, etc. So that's entrenched now. So is it that crazy to think that we could actually eventually come up here and peak and then break back down and then peak again and just essentially repeat something like this? Even if it's not to the magnitude, maybe we don't make it up to 15.8%. But I mean, is it crazy to think that after breaking through the 1990 high, is it that crazy to think, we're at 5.425 right now. Our last peak was from 2001. So then once we took out that peak, we go back another 11 years. And then from that, what's our last peak? What's our next highest peak? I mean, 12.26%. So, I mean, I'm not saying we're going to get 12.26% inflation. What I am saying is that if we break through this level, based on technical analysis, that's our next area of interest. You could argue, well, maybe we'll look at actually like this support right here. Instead of looking at this resistance, the top, we'll look at the bottom. Okay, that's fine. We could do that. You could say, well, what about this one? Well, that basically lines up with this one. So we'll assume if we make it through that, maybe we run into some resistance around 7.5. Maybe it's up here at 10. Maybe it's the next peak at 11.6. Maybe it's the next peak at, 15.8, et cetera, et cetera. You get the point, though. The point is, though, is this technical analysis, this chart right here, this very, very important chart is telling us we have broken out of a 30-year bear trend. We're in the process of a bull trend. And over the last, since we broke through our 2020 peak right here, we broke through that in October of 2021. So in less than 1 year, that was in 2021 this took place. In less than 1 year, we have literally taken out all of these previous lower highs. And now here we are back at like 1991 levels. So we just took out 30 years worth of data, consolidation, etc. And now there's not a lot stopping us from a big jump up here based on technicals. Now, you could say, well, this is just a chart and you're doing technical analysis and it has nothing to do with like inflation or anything like that, or the bond market's not agreeing with you or whatever. We're just doing some technical analysis here, okay? So now that we have all the just basic idea of what this chart is telling us and why it's so important, let's get back to these recessions and let's get back to these peaks and see which one is telling us what about the other one. What can we say with 100% certainty based on past data? What can we say with high levels of certainty, etc.? So we're just going to do the same thing again. We're going to look back right here and we're going to look at each of these big peaks right here. That's, obviously big peak, big peak, big peak, big peak, big peak, big enough, big enough. We should pay attention to it. Big peak, big enough, arguably, even though we had a peak right afterwards. And then, you want to look at these ones. You want to look at where we're at now. Is inflation done? Is it entrenched? Is it going to keep going into the future? Well, me personally, when I see a line like this, when I see a technical breakout where we take out a previous high, that's, it's not a blue sky breakout because we're not at all-time highs, but you immediately start backtesting previous resistances. So we backtest 2008, then 2006, then 2001, and now here we are, threatening 1991. So we have key areas of interest, but when we see a chart going parabolic like this after a technical breakout of a 30-year downtrend, is it a wise idea? Is it sustainable? What is our probability of success of calling the tops? And is that a good idea? Of course not. It's the worst idea you could ever have in your life. We literally just broke out of 30 years. You had 30 years to just trade with the trend, and now the trend is switched. So why are we going to trade against the trend now? We're not. The trend is up now. So it's bullish. Inflation is bullish. So that's what we're looking at. So now let's look at those peaks and let's look at, when we had a recession. Well, here we see a clear peak where we didn't have a recession in 1986. Here we see a clear peak here in 2006. We didn't have a recession until, 2008. So that's kind of a strange little outlier. And then here we saw some kind of peaks, but in hindsight, we know that actually this was the trough and this was the peak. And then that was the trough. And then we're still in the progress. So there's some, data points we could argue, like what's the validity of this one? Because technically it was a low, then it was a high, then it was a higher low, then it was a higher high. So technically we were in an uptrend at that point in time. So this was actually just part of this move. So really from the low right here, this is just some noise on the way up to our high right here. So that's why we didn't have a recession right here, because it wasn't actually the peak. And then you could argue right here, and I wouldn't disagree with you, that, well, actually this was a peak right here. and then we didn't have a recession until 2 years later. So is this an anomaly? You know, sure, definitely. It's definitely something a little bit different, presents a possibility of something we could see going into the future, where we could basically peak, roll over, not get a recession, and then actually come back up, put in another lower high, and then get a recession. So sure, that's definitely a possibility. So now let's look at which one happens first. So where the gray area starts is where the recession starts. So here we see the recession started in 1969. Okay, and the recession actually went until 1970. Okay, so a 1-year recession. And then in 1970, actually, CPI peaked after the recession was already over, which obviously means that it peaked after the recession had started. So we have one instance of the recession followed by the peak very shortly afterwards, and then massive, we went from basically inflation was 7.4% in December of 1970, and then inflation was 2.8% by 1973. So 3 years later. And at that point in time, probably people thought inflation was gone forever. I mean, in hindsight, obviously we know that they thought it was gone forever. And then what happened next? So here we see, again, we start going parabolic. And then where does the recession start at? Okay, October of 1973, the recession starts. And then we see continues to go absolutely parabolic. And then when does the recession end? Okay, interesting. February of 1975. And what happens shortly after the recession ends? Oh, okay. CPI craters. All right. And then we put in a higher low. So far we have two instances where not only did the recession start, but it actually finished before the CPI even peaked. So that's important. So let's see what happens on the next one. Spoiler alert, you're going to see a pattern. The next one happened right here. And this was obviously, the famous Paul Volcker type situation deal, that everybody talks about, but nobody knew who Paul Volcker was, 3 years ago. That being said, January 1980, go into a recession. And then when does the recession end? June of 1980. And what happens to correspond with the peak? Oh my gosh, look, it's the end of the recession and then CPI craters. Okay. And then we actually see a trough right here and then start to go parabolic again. We see obviously still another higher low. So we can't confirm that we're in a bear market yet. And then, lo and behold, recession, 1981. Hello, it's back. And then what happens after that? We peak September 1981 while the recession is still going on. So now we see 4 specific instances where every time the recession started before the peak, and in 3 of those instances, the recession was already over or ended right near the peak. So you could argue that we're seeing the possibility that actually the recession might be what causes the peak. Or at least, even if it's not the cause, we can see a correlation, or that the leading indicator is the actual recession to the peak. So that's very, very interesting. Now, we need to pay attention to that was all during an uptrend, and now we're going into a downtrend. So we need to pay attention. Does that change the data? Does that change the correlation? Do we see something between these numbers that we don't see through these numbers, so that maybe when looking at these numbers and trying to predict what's going to happen, we should only look at these? Maybe we should look at all of them, but weight these heavier? Maybe we should look at none of them. So lots of options, but worth paying attention to all the variables, because that's something people forget all the time. They'll try to compare 2 data sets, but they forget how many variables are inside those data sets. And everyone that's ever done, scientific experiment, obviously you want to have a data set that does not change, a constant. That way you can always compare to that constant. That control group is what it's referred to. I'm sure you guys already know, probably stating the obvious, but if you don't know, that's what you want to do. You want to have one data set that is not manipulated at all, that is just pure and beautiful and whatever. That way you can compare everything else to that. The problem is when that data set is not exactly the same, now you start comparing stuff and you go, oh, okay, so there we have it. And you've actually made, poor assumptions or conclusions based on, some sort of variable that you didn't realize. So that being said, we'll pay attention now. We put in our low, come up here. Again, this does not end up in a recession. Comes down from 5.37 to 4.17. So you could argue 1.2%, in the CPI, arguably 25%, roughly decrease, is enough to be note. But we know obviously in hindsight that, we just came down and put in a higher low and then went higher still. So the next recession we see here begins in July of 1990. And you're probably like, okay, dude, we get it. We don't need to see any more of these. But we're still going to go through them anyway. So go get yourself some popcorn. So July 1990, we go into a recession. And then shortly afterwards, we peak. So September 1990. And then after that, melts down for the next 10 years. Okay, so definitely picking up some stuff here, okay? And then next, we put in a lower low. And then, of course, 2001. What happens? Recession, followed by, oh, look, again, a peak. And when does this peak occur? Right around the time that we come out of the recession. So here we have 1, 2, 3, 4, 5, 6 instances so far. And then we can look right at this one and tell when it starts in 2007, the recession comes before the peak. And then after that, while the recession is still going on, we melt down to a new low. And then again, our final instance right here, the recession begins. And right when the recession begins in March of 2020, we know what that was. We melt down, but this time we put in a higher low. So we have 1, 2, 3, 4, 5, 6, 7, 8 data sets. And we have a, 54 years. So we have 8 recessions, we have 8 peaks, and we have 54 years worth of data. So what can we say based on that 54 years of data? Well, every single time we entered into a recession, we peaked shortly afterwards. What about the other way around? Every time we peaked, were we already in a recession? Well, no, we weren't, because here we peaked and we didn't go into a recession. So we have 1 point. And again, you could argue, well, actually, this is the low, and then this is the high, and then actually that's the low. But because we have a higher low right here, and then a lower high, this would create confusion in real time. But the recession would obviously tell you, oh, look, we're actually about to peak and go lower. So every single data point with 100% accuracy from our recession, could we tell that the CPI is going to peak? So that being said, now that we know that with 100% certainty over a 50-year time frame and, a nice sample of data points, we know that there's no reason that we should even begin to fathom, to even imagine, let alone talk about, let alone have conviction on saying that CPI is going to top before we go into recession. So the Dems want to argue. Everybody wants to talk about the real, way that a recession is determined. Whatever. Who cares? Okay? Who cares? It doesn't matter. There's multiple ways you can do anything, including, determine if we're in a recession or not. Historically speaking, the basic, just simple, easy way to put it is, if you have 2 consecutive quarters of declining GDP growth, we're in a recession. Obviously, things have gotten crazy. The level of, fingers on the scale has gone just through the roof in the last, 30, 40, 50 years. But the fact of the matter is, we can say with utmost certainty that before the recession, or before the peak, comes a recession. So maybe we're not in a recession. Maybe we are. But you know what I know is, we're definitely not going to peak on CPI with 100% certainty based on previous data. Now, does that mean that going forward, we can't do something different? No, it does not. We could 100% just roll over. We don't go into a recession. Everything's gravy. And we just do something we've never done before in all of existence. That is always, always, always a possibility. But I like my odds. So we have, what did we say? 4, 5, 6, 7. So we have 8 data points here that tell us we need to confirm into a recession before we peak. So anybody calling for peak inflation? Sure, I'll believe it when I see it. Because you want to know how many other people were calling for peak inflation all these different times and were wrong? Probably just about everybody. Probably about 99.9% of people. So when it's all said and done, you could argue if the number one determinant of everything right now, and we were talking about this in the group in depth, the number one determinant right now for everything is the Fed. We know that for sure. And the number one determinant for the Fed right now is inflation. And then the number 2 determinant for the Fed, which is completely irrelevant right now, is employment. And we specifically know for a fact, based on Jay Pizzle up at the podium, that they have no problem. As a matter of fact, you could argue that their goal is to decrease labor participation, or I shouldn't say labor participation, decrease the unemployment numbers, aka increase unemployment, aka some people got to lose their jobs to get inflation down. So they overshot way to the one end on employment data based on whatever. You could say, well, the employment data actually isn't correct because people are leaving the jobs market and they're no longer counted if they haven't done that. I get it. I get it. I get it. I hear this nonstop, okay? But the fact of the matter is, we are going to use the data that 90% of the other people are using. It's fun to use all the other data and John Williams shadow stats and let's go over here and all this and that and other. But you know what? You know what percentage of people are using that data compared to the percentage of people who are using this data? It's tiny, itty bitty itty. Okay, so we can use that data too, but let's use the real data, you know, whether we agree with it or not. So that being said, in my opinion, I could say with great confidence, okay, with that Tony the Tiger confidence, that I don't see any reason to think, assume, or even speculate that inflation has peaked. And if anybody else could point it out based on anything on this chart, I'll be glad to listen to it, but I just don't see it. So that being said, you guys basically just hacked the matrix because obviously no one else knows about this, or they would be talking about it, because it's a pretty big fucking deal. If you could literally predict when inflation is going to peak with 100% accuracy over 8 data points and 50 plus years of data. But whatever. I mean, you know, we're just random people on the internet. And also, obviously, you know, full disclosure, you know, don't listen to anything I say. This is obviously for entertainment purposes only. You know, none of this is financial advice. I'm not your financial advisor. I'm not going to give you any tax advice, all that good stuff. But probably worth paying attention to this. All right, so now that we see technical breakout, went into deep dive on inflation. Everybody else is going to give you all kinds of inflation news and inflation data and everything. But I doubt that you're going to find anyone that literally breaks down an inflation chart and explains it and gives you causation versus correlation and, you know, essentially leading indications as to what we can expect and draw conclusions from. I just honestly don't think you're going to find that. If you do, let me know, because I always like to have, you know, other people on the same page. So that being said, that's it. That's our in-depth for today. I just wanted to take a look at that. Matter of fact, I think that was such a powerful chart. We're just going to go ahead and wrap up the stream there. So, no, I'm just kidding. Seriously, though. I'm just serious about just kidding. So anyway, that being said, let me know what you guys think of that in the chat. Did you learn anything from that? Is it useful when I go on to these, like, you know, 20, 30 minute long, you know, tirades or rants or, you know, knowledge drops or TED Talks, whatever you want to call it? Or am I just like drilling a point home that's unnecessary? Because I really want to know, because obviously I want to cater all this stuff to you guys. And it's much, obviously, these streams, let's be real. These streams are for the group members. Everybody else gets to participate out of the kindness of, you know, our hearts. But these streams are for the group. So that being said, hopefully we got that all laid out and everything. And you guys let me know what you think, if you learned something, if you have any questions, etc. So much, much easier, obviously, for me to explain that stuff live on stream. But, you know, I basically wrote a novel in the group chat today. So, all right, so moving on to TNX. So obviously we saw TNX come down here recently on the daily and put in a new low. So we have a high, we have a low, we have a lower high, we have a lower low. We're in a clear downtrend, obviously, in what is clearly a daily uptrend. We have left the bearish control zone. We have a hard buy signal. Reclaim the 8, back test to 21, put in a higher low, put in a higher high, put in a higher low again. And now look, we're in between the two of them, consolidating. The longer we spend in this range, the more likely it is that we break to the upside based on our momentum from the indicator oscillators. Multiple green histograms. The slope line is red. We're still below the zero line. So this is basically, you know, step 1 on the TDMACD of bullishness. You know, next step being crossing the zero line, crossing the slope line flipping blue. That would give us, you know, 100% TDMACD bullishness. Obviously here we left the bearish control zone. That's our first indication. The second is the hard buy signal. So, you know, obviously on like 2, once we're in the bullish control zone, that is 3. The knife crossing over, that's worth note as well, depending on if you're going to use that. And then obviously when we look at the moving averages, you know, we're looking at, are we above the 200 exponential and simple? Yes. Are they postured correctly? 200 exponential above the simple? Yes. Are we above the 8 and 21? Well, we're above the 8, not above the 21. Are they crossed to the upside? No, they still have a bearish cross. So, you know, again, we're starting to get bullish by reclaiming the 8, but until the 821 cross back to the upside, you know, we're not going to be like super bullish short term, but we're still very bullish on the actual trend. So that being said, because we put in a high right here and a low right here and then a higher high right here, as opposed to if this was a lower high than this right here, we would say, okay, now we're in like a longer term downtrend, but we're actually not. We're still just in like what I would call a corrective downtrend because we didn't put in a macro lower high. And what do I mean by macro lower high? Well, arguably looking at this, it's pretty clear that this is all just part of one move right here. Okay. Damn, I always have so much drawings on my shit. I like go to draw again and I'm like, why even bother? There's already so much shit on this chart. So essentially what we're looking at is, you know, and depending on how we want to draw this, how we look at it, you know, etc., we're looking at something along the lines of, you know, like this, basically just a series of lower highs and lower lows inside of a range. Maybe we could, that looks pretty good right there. So, you know, we have basically a high, then a low that each touches the top and the bottom respectively, then back at the top. So now we have 2 touches on the top and then back to the bottom. Now we have 2 touches on the bottom. So that's nice. I like it. We got a high, a lower high, a lower low. This is an internal portion of this right here. And now we're just in that range. So what are we looking for? Well, we got to break out of this range. We're going to break to upside. We're going to break to downside. Well, typically this pattern right here, we would break to the upside, probably put in a lower high and then roll over, typically. Now we're in a bull trend, so we don't want to trade against the trend necessarily. But, you know, we know obviously there is this, you know, head and shoulders pattern right here as well that we had identified. And once we broke down from support and put in that lower low, we technically have lost, you know, support from the head and shoulders. We then came down exactly to the bottom of the channel, which didn't exist at the time because I hadn't drawn it yet. We have the 2 fibs, key fib levels here for the macro and like the shorter term fib as well. And, you know, plenty of support obviously there. And then a front run of the 200 exponential and simple. Obviously, the more bullish a trend is, the more we will front run those, as essentially people will be in a hurry to buy the dip. The same way in selling, you know, in a bear trend, we would be in a hurry to sell the rip. So people would front run targets to make sure that they get in and out of those positions. Because the last thing you want to do is be like, oh, I'll just buy the 200 exponential when we get down to it. And then we come down to it and then we just rip to like 7%. And you're like, oh man, I never got my position opened. Happened to all of us. It's going to happen again. So, you know, you can space them out a little bit. You can front run. You can do whatever you want. But that's what's happening right here. So that being said, it looks like we're finding some support for now. It looks like we're trying to bottom for now. We're going to run into the top of this channel at the same time that the 8 and 21 start to cross to the upside. And then if we're right, you know, essentially what we would be looking at is, and we would just assume that actually we're probably going to just go up there and put in a new all-time high because we're still in a bullish, you know, or cycle high because we're still in a bullish trend. There's no reason to think we're not going to, but at least we could take the measure move and say, okay, let's say a few days from now, maybe like mid next week, what is that, August 15th, we, you know, come down here basically, come back up to the top, the 821 are crossing the upside. Let's just say we get the breakout, we break out, we come back down, confirm. That's our measure move. That's what we're looking for. Basically, take us back up to the previous high from the 2020 level, which we obviously went slightly higher than here. And then at that point in time, you know, are we just going to go slightly higher into a new all-time high or cycle high? Yes, probably. So that's what I'm looking at here on the Treasury. We know for sure, too, that this whole entire like run up while everything else has been selling off, the 2 bullish things, the 2 bullish, I shouldn't say the 2, because, you know, energy and commodities have been bullish as well. But the 2 bullish factors that we want to pay attention to that's been causing all the stress or downside pressure or headwinds for all of the equities that we want to speculate on is obviously, you know, rates, yields, whatever you want to call them, and then the dollar strength as well. So as long as we see this in a downtrend, the dollar in a downtrend, it makes sense that equities would do well. But if we see this start breaking back out and going back into an uptrend, if we see the dollar strengthening again, then we have to start paying attention, saying, okay, what's the likelihood now that everything else is going to continue to rally? And obviously we'll look at the dollar here in a second. Still very bullish on yields in general, but we do want to pay attention here. Obviously you're hearing all over again. I hear it mainstream, left and right, from literally anybody, everybody, saying The Fed is going to break something. The Fed is going to break something. We're buying bonds. You know, we're starting to build a bond position. All this just bond talk over and over and over again from like actual technical analysts, not just like, you know, retards with a microphone, like people that should know what they're talking about. So am I wrong? And the bond market actually is going to like crush it and yields are just going to roll over and go down from here? Maybe. Are they right that everything's just going to go parabolic? Maybe. Am I right? Maybe. Are they wrong? Maybe. Is there enough of a case to be built in one direction or the other that now we should just start buying bonds? No, fuck no. I mean, now I'm talking about like actual bonds too, like bond portfolio bonds. I'm not talking about like, oh, I'm going to speculate on like some short duration bonds because I don't want my money just sitting around while inflation. I'm not talking about that. I'm talking about like legit portfolio, like investment moves. Is now a good time to be buying bonds? I don't think so. Is it a bad time to be buying bonds? I don't know. I do not know. We'll have to wait and see. But what is this telling us? Well, if this is the Treasury on the weekly time frame for the 10-year, well, what are we seeing here? Well, we know what this is. This is our favorite kind of chart. You guys know I get giddy when you guys send me charts like this. Okay? I get excited. You want to know why I get excited? Because it's easy fucking money. That's what we want. We want the easy fucking money. I mean, it's not because we're lazy. It's not because we have better shit to do. It's because it's way easier to just walk over and pick up a bag of money than it is to like hope and wish and pray, you know, and, you know, lose sleep over it and stare at our screens nonstop because we're afraid to trade it. Fuck that. We want the easy money. We'll go over, we're going to pick it up. Jim Rickard style, okay? Oh, wait, that might be the wrong Jim. Anyway, I wish I could take credit for that, but I can't. That being said, what are we looking at here on the weekly? Bear market goes to zero basically. Back test, consolidates, higher lows. Obviously, we saw clear bullish divergence taking place. We were able to identify literally the bottom. And you're like, oh yeah, it's really easy to identify the bottom when you go to zero. Well, sure, I get it. I'm with you. It was super easy. But how come nobody else was able to do it? That's super weird. Is it because they're retarded? Maybe. Is it because they don't know how to use technical analysis? Maybe. Is it because they let fundamentals cloud their brains? Maybe. Is it because, what else? We could think of lots of other stuff. Oh, okay. How about this one? That they were biased and just assumed that what has been happening for like the last 30 plus years will continue to happen? Yeah, maybe. So regardless, we know that literally like no one else in existence was able to identify that we were transitioning into a rate rising environment. And yet here we are. I mean, they were able to identify it, sure, eventually, way, way after the party. But obviously we saw this as the first sign to back test and then eventually go into a bull trend. And then once we get above the 200 exponential and simple again, we smack our head on the 200 exponential, smack our head on the 200 exponential, smack our head on the 200 simple, break through them, back test them, off to the races. What happens when we go off to the races? When we break above the 200 exponential and simple? Always, always, always. We back test. We back test, always. Now, do we have to get to the 200 exponential? Nope. Do we have to get to 200 simple? Nope. What does the market like though? And we know this because they literally get down on their knees and beg for it nonstop. They want forward guidance. They want some kind of reassurance, okay? The market is like an insecure little girl, okay? And when I say little girl, I'm talking about of age, not like weird stuff, okay? I'm talking about insecure and needs that positive reinforcement. Or it could be a boy. It doesn't matter. A guy, a girl, it doesn't matter. But you need that positive reinforcement to gain confidence. You don't believe in yourself yet. So you need everybody to reinsure. You need that positivity all the time. Oh no, it's going to go up. We're going to go up. Don't worry. Don't worry. We're going to put in a higher low. We're going to consolidate. We're going to find support. I promise. We'll be much higher. Wait, that's what the market wants. Okay. And how does it get it? It gets it by back testing. And that's where it builds its confidence at. So that's why it's so important for this back test move right here. So while I'm still macro very, very bullish on treasuries, especially now that we see the 200 exponential on the weekly has crossed above the 200 simple on the weekly, it is very possible we go into a short rally like this and then we end up rolling over. It's very possible that we go into a massive rally and we break out and go to 20% or a new all-time high. Anything's possible. It doesn't matter though. What matters is short term and how do we make money off of it. So this is a very bullish cross right here. We're now, above everything. Obviously now we're below the 8. Still crossed to the upside, which is okay, but it definitely looks like, you know, some weakness showing up here. We obviously see the weekly bearish divergence. We broke down from the bullish control zone, hard sell signal, you know, very, very clearly getting ready for that back test, which is great. We want that. So we're looking for an opportunity somewhere lower here. Now, what could happen if our macro thesis is right and actually like rates aren't going to go down? This could just start shooting back to the upside, just go absolutely parabolic, go to a new cycle high, new all-time high, and probably be at, well, maybe not new all-time high, but probably be around 5% before long. What else could happen? Well, it just rolls over and actually like the yield curve inverts like insane, and there's weird stuff going on with the treasury yields in comparison to the Fed funds rate, and none of it makes any sense, and everybody's just brains turn into like mush, and it's like, oh, it's because of this, it's because of that. No, it's because of the risk, it's the time frame, it's the Fed's wrong and the market's right, and the bonds and the, who cares? I don't give a care. I don't care at all. All I care about is how we're going to make money. We don't have to explain anything except for our thesis on how we're going to make money. And the final nail in the coffin for why everybody else is looking pretty dumb right now is obviously this move was clearly, you know, it was very clearly what was going to happen here. But now at this point in time, you know, we have come up here and broken above the 200 exponential and simple. And we're essentially just looking to close a couple monthlies right here so the market can be like, get that feeling like, oh yeah, you're so handsome and you're so strong and you're just such a good trader and all you do is make money and your confidence is through the roof and you're tall and you got dark skin and blue eyes and just, you're just a stud. That's what the market wants to hear. They want that positive reinforcement, and they're going to get it by consolidating at or above the 200 exponential and simple and then going higher. And you say, but it looks like we're rolling over. Sure, maybe we are rolling over. You know, maybe we're going to do something like this though, where it looks like we're going to roll over and then we go back up. And then it looks like we're rolling and then we go up, and then eventually we roll it. Definitely a possibility. Not saying that there's no way that this can go down. What I'm saying is there's definitely a case to be made that once we confirm this breakout right here, that the last thing you want to own is treasuries of long duration. Really of like any duration, okay? Other than like super short duration. And the reason I say that is if you buy a treasury and lock in that yield, and then you wait the duration, let's say you buy a 10-year treasury and you wait 10 years, you get your money back regardless. It's only when you start speculating on these either through like paper contracts or like the aftermarket, you know, bond market basically, that you lose your principal. Because when you loan money to the government, they promise to give you back your money. Now, do you get back the buying power? Hell no. But you get back your money. So if you pay $100 and then you lock in that 4% yield or whatever for 10 years, you get 4% per year. And then at the end of that 10 years, you get back your $100. The problem is that if something changes in the meantime and you need that liquidity, you have to sell that bond. You have to sell it onto the open market. And then at that point in time, it takes into account essentially the discount rate or the premium that you're going to have to pay or receive for that bond when you go to sell it over the face value. And that is obviously determined by the inverse relationship of, you know, the rate itself to the bond price, which obviously is determined by, you know, the risk affiliated with it for that duration, and then also the interest in people to purchase that or demand. So when it's all said and done, bonds aren't necessarily terrible, but I would just be real careful locking in longer duration bonds. Because I'm going to tell you right now, let's say we lock in a 10-year treasury at roughly 2.75%. And then let's say we're right and this breaks out and then we shoot up here to 5%. How much do you think this bond is going to be worth if you have to sell it? And how stupid are you going to feel if you just locked in a 2.7% rate for 10 years and now everybody's paying 5.2? So that's why nobody's going to buy that bond from you unless they're going to buy it at such a discount that it's worth holding at the 2.75 range versus the 5.2 range they would get if they just went out and bought a new bond. So that's what drives the prices down, because people want it less because it pays so much less than just going out and getting a new bond. So you guys already know all that stuff, but again, nice to just lay it out and kind of just, you know, lay the foundation that we build all the rest of our technical analysis upon. And it's always a good idea to come back and just kind of check in on that foundation, or like, you know, kick the tires, so to speak. Make sure we're up on it. Make sure our tools are sharp. So if we confirm this breakout right here, which we haven't done, in the same way that we confirmed a breakout on the CPI that we showed earlier, well, likely this is probably going to go parabolic. And so if we already broke out on the CPI, and we haven't technically broken out on the Fed funds rate yet, but we're less than one hike away, which the average hike is 25 basis points like minimum. So if the Fed's going to hike 25 basis points, let alone, we've had so far a 25, a 50, and 275s. So they're probably not going to hike less than 25. So if they hike again, that was the chart that we showed off last week, and the ones that I posted up in the chat for the group chart section. Essentially, that confirms the breakout. So then we have a breakout in Fed funds rate. We have a breakout in CPI. We're very close to a breakout in the 10-year Treasury yield. And we're very close. Well, technically, we've already broken out on the dollar. So that's all the things that tell us the likelihood of us getting some crazy bull market rally and going to new all-time highs. I mean, 10%, 5, 20, I don't know, but it's not good. It's not 50 plus. I'll tell you that much. It's not over 50% chance. And you know what? And if that changes, it's going to be very, very obvious. We'll know way ahead of time, and we'll very clearly be like, oh, and that's it. New all-time high is coming. Whatever the catalyst is, we don't know. We don't know if it's going to be a black swan event. We don't know if it's just going to be, dumbass politicians, dumbass Fed Reserve, whatever. We'll figure it out. It's going to be pretty obvious when it happens, if it happens. So anyway, finishing up on the monthly chart, very close to confirming a monthly bull trend. And what is our favorite kind of chart? Okay, the one that just gets melted down. The longer the time frame, the better. Okay, that just gets its ass kicked in, handed to it, quits. Nobody wants it. Everyone believes that it has been going down so long that it's absolutely unthinkable that we could ever go up again. It's a fact that Treasury yields will never put in a new higher high. Not after this trend to the downside. They're going straight back to zero. And there's a 0% probability that they will go any higher. And under no circumstances will they ever close a monthly candle above 3.2%. Because, well, that would be confirmation that we broke out of the downtrend. And then, well, of course, that would just literally pour gasoline on the thesis of 90% of people in finance and just light it on fire like the Joker. So that's impossible. Or everybody's just got recency bias. And we're just the only ones that still have functioning brains that haven't been turned to mush by, Federal Reserve and FOMO and, bull-tardedness. But it's whatever. I mean, that just gives us a massive advantage over everyone else. And then if we're wrong, it's like, oh yeah, we're wrong. We'll just do what everybody else is doing. That's not going to be hard to figure out what to do because everybody else is going to be doing it. So that being said, blue slope line on the TDMACD, all green histograms, above the zero line, above the slope line, bullish control zone, above the 200 exponential, above the 200 simple. 200 exponential has flipped bullish. 200 simple is flat, essentially. They 8 and 21 are postured to the upside. We're above both of them, and it's just a matter of time before they cross above the 200 exponential and simple. Very, very bullish. But right now, what are we doing? We're just telling the market, hey, you're so pretty. Your hair is so long and blonde, and I love your glasses, and your ears aren't too big for your head, which is good, and you have the perfect, hourglass figure, and, you're just reassuring. Just, that's what it wants to hear. And then eventually it says, you know what? I am actually like pretty damn attractive and tall. And you know what? C-Cup's all I need. And you know what? We got that cake too. Okay. Boom. And the next thing you know, we're ripping to the upside. Or not. Or maybe just all of this goes to zero. But built a pretty strong case, I would say. All right, so let's keep on rolling. And we're going to rip through here with a little bit of speed now, too. You know what? I actually want to jump over really quick and just do the dollar. Just so we'll have all of them in quick succession because they're so important. So obviously our dollar chart here, put in a peak, hard sell signal. Stoch's aggressively trending to the downside, reached the bearish control zone, red slope line, red histograms below the zero line. Very bearish short term for a correction. Now, what is worth paying attention to is that we actually went to the bearish control zone. We did get a hard buy signal, and then we rolled over from there. What we're expecting now is to come down here. We've already threatened the low or put in a new low. So if the stochastics come down here, which they're obviously bullishly crossed, if they come back down and bounce off of the pink stochastic, which tends to happen and will probably happen this time, we'll bounce it and then go to the upside. We'll then have a higher low on the blue stochastic, which is obviously bullish divergence because we put in a lower low on the DXY. And then that would be, essentially a catalyst to the upside. It is worth note, obviously, 8 and 21 have crossed the downside. We're still very bullish above the 200 exponential and simple, both with a positive slope. But we're in the middle of a correction. We're back testing key levels of support after literally coming from, extremely, extremely low levels and almost perfectly hitting our 2 Fibonacci targets, which obviously if we zoom out, we could see all that. But you guys have seen it, probably 1,000 times. So you know what's going on here. So how far are we going to get back down here? Are we done? Are we going to go a little lower? Are we going to go way lower and hit the 200 exponential? We don't know. We don't know for sure. But what we do know is here, we were all the way at the peak in price. And now it's not technically price, but 108 was our peak around here, 109, whatever. And now we're at 105. So we're not far off the highs. And where are we at in relation to our indicator oscillators? Well, we were massively high here on the stochastics, 92 inside the bullish control zone. And then we made it all the way down here to 15 inside the bearish control zone. And where did we go on price action? Nowhere. We went literally nowhere. The last time, as a matter of fact, we were down at those levels was back here. So we came from 101 and now we're at 105. And, essentially we're at the same levels as we were there. So we see essentially, what does that mean? It just means that as the market breathes in and breathes out, as it oscillates, up and down and up and down, the slope of the oscillation is to the upside because we're in an uptrend. And obviously that's what the 200 exponential and simple tell us. So we would expect to continue putting in lower highs or higher lows and higher highs. So daily, again, looks like we could potentially have another push down here. We're looking for bullish divergence off key support and then another explosion to the upside, which would correspond with obviously an, equities dumps. So DXY on the weekly, so obviously very, very strong trend. This clearly looks like a downtrend correction inside of an overall uptrend. We are technically below the 8 right now. We have closed below the 8, but never below the 21 in this entire uptrend. So the key level to watch will be 103.60. Let's just say 103.50. If we start closing below 103.50, then it's worth paying attention to. If we start bouncing off of it and keep trending higher, we're fine. We're fine. And what do we see taking place right now? The absolute best thing in all of existence, in all the world. We see not only have we just flipped a longer time frame chart bullish, the weekly, but now the 200 exponential is crossing above the 200 simple, which is the absolute, most bullish beginning to a massive trend. Now you say, well, wait a minute. You just said short term, it's probably going to go down. And you said medium term, well, hard sell signal, left the bearish control zone, re-enter the bearish control zone, left the bearish control zone again, multiple red histograms. So it looks like we're going to go down, to which I would say it does indeed. Short term. But what are we doing? It's just coming back to get a couple more compliments before it gets that confidence back and rips to the upside. Or I'm completely wrong and we lose the trend and we go to zero. But, strong case. We got a strong case, ladies and gentlemen. And then if we look at our monthly here, again, what do we see? 200 exponential, above the 200 simple, both blue slopes trending to the upside, 8 and 21 in a bullish posture. We are literally nowhere near the 8, let alone ready to lose the 8, let alone ready to lose the 21, let alone ready to have an 821 bear cross, let alone to come down here and lose the 200 exponential and simple, let alone to lose the slope on the 200 exponential and simple, let alone to be in a bear market. And anyone that says that is a, say it with me now, retard. Oh, wait, I don't think I'm saying that anymore. I think I'm going to say, from now on, moron. Because I don't want to, offend anybody that's actually retarded, because I feel like that's not by choice, but being a moron, I feel like is by choice. So anyway, what do we have here? Clear bear trend. What do we do here? Confirmed into a bull trend for the first time. And, this chart goes back. Arguably, this is when we lost the bull trend. So let's just say 1985. So again, what do we see here? 40-year downtrend that has now confirmed into an uptrend. And where's the next area of interest since we just took out the previous two highs? Well, it's right smack at 120. So we still got a ways to go. So maybe we come down to 103, 102, back test this area right here, but eventually, very likely back up at 120 before long. And again, what does this mean for equities? What does this mean for foreign investments? And when I say that as someone who lives in the United States. It says that we actually don't want to be investing in foreign markets right now because the dollar is entering into a massive bull market in relation to that basket of currencies. Now, that being said, we have pointed out in previous streams and discussed if we break down the basket and look at each individual currency, actually, if there's one currency that still looks good and strong, not based on fundamentals, but based on technicals, it's Canada. And where a lot of the stocks that we're interested in investing in outside of the United States, well, they're Canadian, of course. Of course. And is there a connection between that? Well, of course. If we live in the United States and the dollar is strong compared to everything else, why would I want to invest in other countries? Because let's say that my investment goes up 20%. And let's say in the meantime, the dollar goes up 20% as we expect. Well, how is my investment going to look? Well, I will break even. Hooray. That's absolutely terrible. So we're basically playing, when we take a foreign investment, we're playing that investment in whatever like asset class or stock that is. And then we're also taking a trade inside of the Forex markets. So we have two trades that need to go right in our favor. Because if one goes right and one goes wrong, we end up break even. If the other one goes right and the first one goes wrong, we end up break even or somewhere close to it. And if they both go wrong, well, we get double kicked in the dick. So that being said, we can move on from there. I just wanted to do a quick little look at the dollar while we're on a roll with those, because obviously those are some of our most important charts to keep in mind. Let me jump over in the chat real quick because we have been going for like an hour now and I haven't really been back over here. So Calma Betty, what's up, Crypto Trend Trader? Good to see you, man. Bitcoin next leg down coming. Yeah, I'm not sure it comes before we get our next leg up though. Interesting chart on inflation. So being that we had, this is Ray B speaking, being that we had 2 quarters of nego GDP, which would technically be a recession. If you plotted that on your chart, one could make a case for peak inflation. Okay, but now you see, that was the thing we talked about though, Ray, about being consistent and not using extra variables and second guessing ourselves and having a bunch of extra things. We want to use our control group, okay? And in our control group, we don't want to wait and find out if CPI has peaked, multiple years later. And we also don't want to just assume we're in a recession when the chart doesn't tell us that. So if the chart tells us we're not in a recession yet, I really don't care about the negative 2 quarters of negative GDP growth. I really don't care. If the recession indicator hasn't tripped, and every other time we're looking at it, I'm sure there was some other time during that period, I can't think of it specifically off the top of my head, where we had 2 declining quarters of GDP growth and that we didn't end up being technically in a recession. So why should we try to create situations where we're not wrong when we have 8 other data points that are 100% accurate over 50-something years? Why not just trust that and go with that? I mean, we can say, well, maybe there's a chance that we're in a recession, but they haven't actually come out and officially. But I mean, do we want to do that though? Or do we want to just use the data without a bunch of extra like ifs, ands, and buts? That's why I don't do that. Is it possible? Sure. But how many charts have we looked at today where people have been trying to call the tops and bottoms on them and gotten their absolute dicks just kicked in, curb stomped, and left for dead? Pretty much every single one. And how many of them have we been wrong about? What was it? All I hear is crickets. So, I mean, it's easy to be confident though, with our track record. And it's all public too, so you can go back and look at it and be like, oh, yeah, makes sense. So Raby says, I'm with you as I don't think we're done, but we know that they don't call an actual recession in real time. Of course, Ray. But that chart right there operates like anything, with year-over-year numbers and is updated, on month with the release of that data. So what are we going to wait for? We're going to wait 1 year from now, and then they're going to come out and say we were officially in a recession, and then all of a sudden they're going to come back and change this chart and then add in gray bars that say we actually were in a recession? I mean, it's possible, but I don't know. Just seems like a stretch. I think we probably just stick with what's working. But it's always worth considering alternate possibilities. And again, I have always classified a recession with the broad term that it's 2 quarters of declining GDP growth. That's always been a recession to me. But at the same time, I understand the argument that actually, technically, that's not really a recession because the recession is actually declared later. So it is what it is, but we have to use real-time data or else, what's the point of our leading indicators if we're using lagging data? It defeats the purpose. Then it's just like, oh, we're back to just no advantage. So Crypto Galt says, yes, it is. Crypto Trend Trader, you have a lot of knowledge to share, bro. Also, replying to, is it useful to have 20M briefs? Replying to, is it useful to have 20? Oh, yeah. Okay, I got you. Thank you, brother. Appreciate that. Ralph Smith says, nice breakdown of the feed rate, the Fed rate, obviously. Sticky chart implications definitely solidifies the concept for sure. CW says, thank you, broski, for sharing. Thank you, broski, for commenting and appreciating the sharing. All right, so let's jump back into it. Keep on ripping through here. We're going to take a look at the VIX volatility index for the S&P 500. Before we do, just a reminder in case you're just tuning in, this is not financial advice. I'm not your financial advisors. Markets are extremely volatile. Please do your own research and trade responsibly. All right, so here we have the VIX been trending. Obviously, this thing is meant to oscillate. Oh, I forgot we drew a bunch of like random ugly stuff on these charts. Don't worry about just random blobs. Some are supposed to be here, others are not. But obviously, the VIX is supposed to just trend basically inside this range. We look for outliers inside the red area or down inside the green area. We know that since 2018, obviously, we have been in the neutral or in the red area, but we have not touched the green area. Worth paying attention to. And a matter of fact, we've spent the majority of the time prior, we're in the bottom half of the neutral area. And now we've been hanging out in the top half of the neutral area. And right now we're doing something interesting. We had a descending channel. We double bottomed with bullish divergence. We broke out to the upside. We obviously have formed a triangle now. So we have an ascending channel with a triangle inside of it. And then arguably now, it's pretty hard to say we haven't broken down from the triangle, from the channel, etc. So all we have left for support now is the, basically like the 21 level, the heart line of our, neutral zone channel. And then obviously the descending resistance, what was support now to potentially act as, what was resistance to now potentially act as support. Now we know the measure move breakdown from the channel or from the triangle. Obviously we didn't know exactly when it was going to happen, but, wanted to account for the possibility of a break up or break down. In this case, the breakdown measure move would be, somewhere down here to like 13 or something like that. Maybe a retest of the lows, maybe the heart line. We don't know. But as of now, it looks like we're breaking down from here. And it looks like we're just going to rip to the upside indefinitely. Because what does the VIX represent? Well, it's like the relationship of people that are, buying puts versus buying calls. The put-call ratio factors directly into this. And what does that mean? Well, typically, who's buying puts? Well, people that are trying to protect themselves from downside moves, but don't want to actually sell their stock. Or people that just want to speculate, obviously, retail, whatever. But that being said, the breakdown from this level would imply that we're going to continue to have just a breakout to the upside. And obviously, the markets right now are looking super bullish. And it's like, oh, we're breaking out. We're running from here. So what are we looking for a potential reversal? Well, some kind of support. Obviously, right now, we're just trending down, which is very, very common for the VIX. But we have broken down from key levels. And there's not a lot of support between literally where we closed today and, essentially coming down to like that 14, 15 level. So we'll pay attention to that. As far as trending to the downside, bunch of red histograms. Looks like it's going to continue to the downside for now. And then obviously we can pay attention to the jewel. And we see we have a low right here. Then we have a higher low. Then we have a higher low again. And now it looks like we're arguably possibly going to be putting in another higher low. We're very close to leaving the bearish control zone. We've already gotten a bunch of buy and sell signals over here. So we kind of had like the buy, sell, buy, buy, sell, buy, but we didn't actually leave the bearish control zone. So normally this is a bullish divergence signal and this is spaced out perfectly. What we want to see is either literally one day with a buy, the next day with a sell, and then the next day with a buy, or we want to see a buy, a space, a sell, a space, a buy. because that's where we look for our divergence. And then once we leave the bearish control zone, that means we're probably going to get an explosive move to the upside. So we're at 14.3 right now. Bearish control zone's obviously 20. So it's still got a little ways to move to the upside. But that could literally easily happen in a day. And then really, what does this chart actually look like if we find support right here and then move back to the upside? What does it actually look like? Well, if we really zoom out here, and I'm not trying to get like too crazy or too creative or anything like that, but let's just be real and just say, okay, we have this descending resistance line, okay? So what if like above that we had another resistance? Like once we broke out, like maybe it mattered. Where would that go? Well, it would look kind of like this, right? So we have this descending channel, and then above it we have, sort of like another descending channel. And then what have we really done? We broke out of the bottom of the one, and now we're in the second one, and then we kind of back to it, and then now we're back to, we don't know what's going to happen here, but it's not crazy to think that we could actually find support on this level and then get a move back up. And that really we were just kind of off a little bit on some of this stuff. Now, again, not trying to make up, possibilities for what's going to happen, just trying to explore situations and build a narrative that makes sense. And then obviously what we're looking for is when we take out the previous lows. So here we have a pretty clear swing right here up to that one. Once we broke down, it is sort of interesting how that triangle is drawn. But anyway, so we broke down to that one. So essentially what we're looking for is, well, we don't want to take out this low, because here we put in a high, then here we put in a low, then here we put in a lower high. So we don't have a lower low yet. So the literally most important level for the VIX right now is that previous swing low. So a high, a low, a lower high. We're looking right here for a lower low. If we break down below that, that's like my line in the sand where it's like, look, we can't pretend like there's still hope here, because now we're confirming we're back in that downtrend. So worth paying attention to for what's going to happen here in the near future. I suspect, and again, this is obviously not financial advice, unless you want to live in a van down by the river, okay? And I'm not talking about a good van. Don't listen to anything I say, but there's pretty good possibility, I think, that the VIX is actually about to like explode to the upside, in the next couple days or weeks. Now, if we take out this right here, that's it for me. I'm done. F the VIX. We're just going to the moon. No one cares about anything. Who cares? Just everything. Rocket. Not even the moon. We're going straight to Mars at that point in time. So U.S. oil. So we've been talking about this oil chart. It's literally done. Everything we said it's done. It peaked when we said it was going to peak. It put in a lower high when we said it was going to lower high. It found support exactly where we said it was going to find support. Oil's our bitch. Let's be real here. But that being said, we need to pay attention to what's happening now. So we got basically the lower high breakdown, and then we broke down from here. We have a very, very clear descending channel that we've been operating inside of. You know what I'm actually going to do? I'm actually going to clean up some of our fun drawing tools. You guys know that we were obviously having a good old time, dicking around with some of this stuff, but I just want to clean it up just a tad bit so we can just see a little bit more clearly. Okay. Because you have a little clusterfuck going on right here. So essentially what happened is we have this descending channel right here, and now we have a high, we have a low, we have a lower high, we have a lower low. So there's no arguing that oil is not in a downtrend right now. Now, granted, we have the 200 exponential and simple right here, and arguably, if they were still bullish, which they're 50% bullish, the 200 exponential is red, but the 200 simple is blue. They're pretty much flat, so it could go either way. But realistically, we don't want to get not bullish right here, because what we should be doing actually is buying the dip on stuff when it comes down to 200 exponential and simple, because it's in a bull trend. Until we break down, we back test, it fails and rolls over. That, or we put in a lower high and it rolls over. So we're still technically bullish on oil right now based on this chart. How many people you think got shook out right here where we break down and then rip to the upside and then they look like idiots? Or what about, right here on the back test, and they're like, oh, we're about to lose the 200 exponential and simple. Sell, sell, sell. And then it's like, oh, and it's gone. So higher lows, higher highs, the whole way up. Oil's still very bullish. But now I want to talk about another situation, okay? Because we see this happening right now in a lot of charts, a lot of charts. Arguably, you could say everything that has been in a downtrend, with the exception of a very small percentage of things, are doing the exact opposite of what oil is doing right now. And you're like, well, obviously, because oil has been going parabolic and 90% of everything else has been going down. So thank you for another useful information drop. But there's something else going on that no one has noticed or is talking about or cares about. And what that is that now we have this high. Now we have this lower high, and then here is our low. And now we have confirmed, without a doubt, that we have put in a lower low. Now, could we put in a lower low than that? Sure, we probably do. But it's worth paying attention to now that we have essentially this top right here. And then maybe we could start looking over here. And you say, well, that's not really that useful, right? Because we have the high right here, the high right here. The lows line up perfectly right here, pretty well right here. And then actually we broke down from it, but we did reclaim it. So arguably, if the chart is supposed to be drawn this way, and we have drawn it correctly, you know, which again, there's just so much going on here. I do apologize for the busyness, but not quite ready to get rid of like the old channel just yet. But that will help once we clear that up. But essentially we have this descending channel right here. We lost what could be this descending channel right here, and then we reclaimed it. So is this just a spring, and we're actually going to shoot all the way back up to the top of the range again and put in another lower high or go to new all-time highs? There's a definite possibility. Now the other situation or scenario, and we don't know which one is right and which one's wrong and how it should be drawn, and there is no right way to draw a chart versus wrong way to draw a chart most of the time. I mean, unless you're like a dumbass. If you follow the like basic rules though of like, you know, drawing a chart and doing technical analysis, there is no wrong way as long as you follow the rules. So as long as you color within the lines, everything's cool. But then also if you color outside the lines, like as long as you know what you're doing and it's intentional, that's cool too. But regardless, we have wicks, a high here and a high here on the wicks. And then here we have a low on the wick, a low on the wick. Don't get the touch on this one, but then that's exactly where the closes are. So which way is right? Well, this way, obviously. No, the other way, obviously. Well, we don't know. They're probably both right. And I'm imagining that somewhere out there, somebody else has discovered this descending channel and is probably drawing it one of those two ways. Now, I don't know which one they're drawing it on when I look at the daily. So what do? I'm going to go out to another time frame. We'll go out to the weekly, and I'm going to see, hey, does this chart look better or worse on the weekly? Well, we know if we draw it based on the wicks, it's not going to change on the weekly, right? Obviously. We know that for sure, without a doubt. What if we try to draw it based on the closes on the weekly? Well, this is a high, and then that's a higher high. So we can't. It would actually be like some sort of like descending, broadening wedge, or like some kind of like neutral megaphone pattern or something like that, which again could be possible, but just too confusing and doesn't change our view one way or the other on this descending channel. But arguably, there's a case for that as well. And then if we go right here and we just look at a monthly, again, we've only been up here for a couple months. Obviously, the wicks aren't going to change anything. And because we have basically just these two exact candles at the top, there's not a whole lot we can do there. So when it's all said and done, not getting any information on longer time frames. Sometimes you'll get it on shorter time frames. It was just something that came up in the group recently, that sometimes I could have a channel drawn one way, for instance, and someone else could have it drawn the other way. And I'm not wrong or they're not wrong, but it's kind of could go either way. And it's like, well, I wonder which one. And then you start looking for breadcrumbs, like which one is correct and which one's not. And sometimes you go to longer time frames and they present themselves. But in this case, obviously, we went to a shorter time frame, and it was very clear on the 4 hour. Oh, actually, the way I have it drawn is correct. And the other way, like, while some people still probably are drawing it that way, you see much less like confluence, or you kind of have to stretch it a bit. So again, it's a very nice tool to do, to go to a longer or shorter time frame to try to get a little clue from the market, like actually which one's right. So with oil right here, we'll just leave it at the wicks for now. Doesn't really matter one way or the other. If we have like an actual spring breakdown, or if we're just finding support. What we do know though is that we're still in a bull trend technically. It's very close to losing that bull trend. Oil has been going absolutely parabolic. We've had a nice retracement right here. We're below the 200 exponential and simple. So when we lose the 200 exponential and simple, the most likely thing that happens next is we backtest that area. So we're expecting a back test. And it just so happens the back test would be the yellow support line for our sideways channel, our neutral channel. It also just so happens to be, right around the top of our descending white channel right here. And then we're obviously bouncing the bottom of the bigger descending white channel, which is super confusing. So we'll just make that one orange. So we're bouncing the bottom of the orange channel. We're getting ready to backtest the top of the white channel. And then we're very close to, obviously backtesting the bottom of the yellow channel as well. And that also lines up with the 200 exponential and simple. So we're very likely to get that little move right there. So it's like, well, we should just long it, right? We should just go all in on that oil move. No, obviously not. 3.8% though does present some opportunity because look how far we are from the bottom right now. So if we're that close to the bottom, which we would assume will at least hold temporarily, if not permanently, 5.2% downside, with only like 4% upside, it's not really like a tradable range or whatever, but that's if we just trade inside the range essentially. If we get the actual breakout, which is what we would be looking for, and we could obviously play this in, oil directly. We could play it in, other oil related stocks, producers, whatever you want to do. But, just obviously the correlation between oil and oil related stocks is very, very close. In some senses, sometimes not as close, but the overall direction, not necessarily like the moves. But, you could argue that if we come up here, we chew through this area, we get the measure move breakout. Now we have reclaimed the channel. We're back at the heart line, some key resistance. And then if we're back there and we just got the breakout, likelihood is we back tested the bottom of the channel a couple times. Maybe we're headed up to the top of the channel. So then the real question is, was the top of the channel going to be here at the red line? Or is it going to be here at the orange line? And you're like, well, they're in the same place. And I'm like, I know, right? Seems like a pretty good place to top out at. And then you're like, well, what's this giant red box? Well, it's the target that we already hit. So now we're going to borrow this box and we're going to use it again to represent where we could potentially go, which in this case, Jesus, how big is this box? Man, I know we've all said that before. You know what I mean? Let's just say she wasn't a keeper. My humor is just absolutely horrendous. I mean, I find it entertaining, but probably normal people not so much. So anyway, this is what we would be essentially looking for like a potential target where we stay inside the range, which is the descending channel. We don't break to a new all-time high, which just means we just continue to trade inside the range, which seems most likely, and we'll see on longer time frames why that is. And that gives us a potential trade setup that's pretty thick and juicy. Okay? And again, obviously, as always, this trade setup's not for you. It's for me. You know what? And if you take this trade setup, I'll know. Okay? And I will know. All right? And you will be held responsible. So don't do it. Because it's not for you. It's for me. I'm just showing you what I'm doing. 24% upside, 5% downside, technically still in a bull trend, bull market, neutral, whatever you want to call it, 4.6 to 1 risk reward ratio, with a target of 114 again, and a downside stop loss at 86.98, below 87, let's say. So there you have it. Voila. Everybody gets free money. Go pick up the bags of money. Or we're wrong and we just lose everything. How embarrassing. But, on the daily, obviously looks like oil could get ready to have another push up here. So now on the weekly, obviously we have the hard sell signal breaking down from here. Stokes angle to the downside. We see the knife putting on a new low, corresponds with the low right here on price action. Obviously red histograms, red slope line below the zero line. Clearly breaking down from here. When we look at our longer time frames, we are still well above the 200 exponential. They are 200 exponential and simple are both still blue and in an uptrend. We have lost the 8 and 21. They're in a short-term bear trend on the weekly. So what does it look like is going to happen? Probably some short to medium-term continuation to the downside. But if we were to find a bottom around this area, or if we already bottom, that's where the trade setup comes in. Could very, very easily go lower. But just looking at that longer time frame, if we lose the bottom of the channel, we really need to pay attention to like that 83.50 level or something like that. And then if that holds, we can always just enter back into the trade. But we don't want to just sit in the trade if we're going to potentially have a deeper retrace, like back to the ascending broadening wedge bottom and like the measure move breakdown, which would put us somewhere around like the 70s. And then obviously on longer time frames, that would give us a 200 exponential and simple. And we know whenever one of these confirms into a bull trend, which oil did back in October of 2021, that typically will have some kind of back test of the 200 exponential and simple. It got front ran the last couple times and started to take off. So this time, obviously we have it already. The 821 have crossed to the downside. Here we saved the cross. Here we had an itty bitty cross, and then we saved it, crossed it back, inverted it, reverted it, whatever. Here we have an actual cross, and we're starting to sell off, losing key support. So it's not crazy to think the trade setup blows up. This actually just sells off here, and then we get a real legitimate back test of like 71 or 63, which you guys know obviously is like my actual like base case. So you're like, well, you just gave us a bullish trade setup that you're thinking about taking, but also your base case is the opposite. That doesn't make any sense. And I'm like, really? Or does it just mean that I get to make money when I'm right and when I'm wrong? Now you're onto it. Now you see what we're doing here. Exactly. So if you can ever figure out how you're going to be right and make money, that's easy. But if you can figure out how to be wrong and still make money, that's pro shit. That's the pro level stuff. So on the monthly, 200 simple is above the 200 exponential. Both are blue. We're above them. We have lost the 8. We're still in the middle of this month, obviously, but you would assume that if we break down, we come down to 21, which is around like 82, 83. Hard sell signal. 3 pretty bearish candles in a row. Obviously 2 red histograms. The second one is this month, so obviously we want to wait till that close for confirmation. Stochs are angled to the downside. Oil looks pretty toppy right now. We see whenever we've had, a decent sell-off like this, it basically looking like a V top or a blow-off top or whatever you want to call it. Most of the time afterwards, we just continue to put in lower highs and then eventually break down, or we just break down right away. Is it possible to get a scenario like this where we come all the way back down and then rip to the upside? 100%. Where does that likely come in at? Probably somewhere around like 75. Could have come down to the mid to low 60s, 100%. But, right now we're looking to buy oil for a short-term scalp, but really we want to be wrong because then we get oil at a much lower price for a long-term position. Know what I'm saying? Yeah, you do. All right, so on to some stonkaroonies. So we did something very important today, obviously. Irrationally shot up to the upside. No, that's not it. Yeah, that is it, but that's not what I was talking about. We actually put in a higher high than this previous high right here on the 2 most important, Dow Jones and S&P. So the potential divergence that we were building is now invalidated. So we did the one thing that we needed to... Oh, wait, hang on. Hang on now. You better pull up that chart and look at it real closely now, boy, before you give us some bad information. Okay? So we have a peak right here, and we have the same peak right here and the same peak right here as well. And now we have a higher high on price action. So actually, we didn't technically invalidate the bearish divergence on these stochastics. So that is interesting and definitely of note. And I honestly did not notice that before just now. We did put in a higher high, obviously here, and a higher high. So we have invalidated the bearish divergence. Trend is still in our favor. Bullish control zone, hard sell signal, still in the bullish control zone. If we exit the bullish control zone, it will look like essentially a rejection. Now, you guys know, obviously, target to the upside was the 200 exponential, but realistically on, traditional markets, stonkaroonies, everybody uses 200 simple. Only some people use 200 exponential. And no one but us uses both. There's probably some other person out there that's just like trying to be cool like us, but no one cool other than us uses both. So that being said, definitely still potential. We see the Dow Jones up here at 34K. Definitely potential. The Dow Jones has already topped. And if we do start to consolidate above the 200 simple, above 34K, we've already flipped the 200 exponential bullish. We're very close to flipping the 200 simple bullish. Could we get a situation like this where we do the exact same thing again and it rolls over? 100%. It could definitely happen where it looks really bullish and then actually, I burp into the microphone. Well, no, that's not it. That happened, but that's not what I was going to say. It rolls back over. So it basically fails. Confirms into a bear market, back test to make sure it's really a bear market. And then it's like, yep, still a bear market. And it's like, are you sure? And it's like, yep. And it's like, okay. New lows and then back test reversion to the mean. And now we need to see what happens here. So obviously we don't presume to know what's going to happen, but we do know one thing. We know that if we trade with the trend, our probability of success, of being right, is much higher, or at least gives us an edge. So in this case, we're very clearly in a bear trend after a very long bull trend. So it's not crazy to think that we do get rejected again somewhere around this area. And if we turn on our chart with the drawing stuff, with all the bright colors and everything, we see obviously that once again, what did we do? Well, we just came back up to like all of our targets exactly. Oh, okay, cool. So what normally happens when we get up to our targets, like a red box or a green box or something? Well, normally the market says, yes, sir, and just does whatever it is that we said was going to happen. Occasionally it doesn't happen. But, here it shot up above and did one candle above, and it was like, oh, you're wrong, haha. And then it was like, oh, you're probably right. And then it was like, nope, you're definitely wrong. And then it was like, actually, we're your bitch. And then just so happens when we drew a blue box down here, the market says, okay, yes, sir, and comes down to our blue box. So we could just assume when we draw the red box right here that the market's probably just going to be our bitch again. And realistically, probably going to be right. But again, anything could happen. Anything could happen. But according to the Magic 8 Ball, we're going to be right again. So on the weekly, got the perfect bounce off the 200 exponential. We're really looking to see the 200 simple get touched, but obviously the market did not care. It was a front run of the 200 simple, or everyone now is using the 200 exponential, and we just haven't found out that they're onto us. But realistically, the 8 and 21 cross bearish to the downside. They're very close to crossing bullish to the upside. In all reality, if we basically just stay above 33K, 32.7, something like that, they're going to flip back over. Bunch of green histograms in a row. We're approaching the slope line. We're approaching the zero line. We have a hard buy signal. Arguably, this run could continue, and it wouldn't be crazy that we're just back up here. Now, if you look at fundamentals and you start looking at some of the other charts, and then you're like, okay, now let me build for you a case on how we go to new all-time highs, I'd be like, hang on, let me make some popcorn, because this is going to be fucking good. Okay, now, so let's just say it's not very likely based on fundamentals, based on technicals, based on literally anything else on earth other than, hopium. But is it possible? 100% possible. 100%. And you're like, yeah, but you keep saying anything's possible. Correct. And that is a very important part to remember. No matter how much conviction you have, no matter what your percentage of right is, no matter how many data points you have over a 50+ year period that tells you every time this happens first, it still does not have to happen. And when we look at the monthly, obviously we did exactly what we said. After that nasty bearish breakdown, we backtested and tried to save the trend. So the real question is now, are we going to save the trend like we did back here and continue to the upside? Or are we going to just backtest, consolidate, and then eventually break down, basically like we did here? Because here we closed, we opened, we actually pushed back up, and everything was looking good and juicy. And then before the end of the month was over, we had that disgusting capitulation. Now, I'm not saying we have to get a disgusting capitulation, but I wouldn't rule it out. But we could easily get something like this, end up going to a new all-time high, and then get it. Lots of stuff could change, but that's why we do these 3 days a week, because obviously not much is going to change from the one day you don't hear from me, or maximum 2 per week. You're like, oh my God, everything's changed. Well, if it's that serious, and you're just like, I gotta have direct access to this guy, he's fucking amazing, join the group. Monthly Dow Jones, we're at the level. If we close the monthly here, it's going to look good. It's going to look like we saved 821. And then literally all we have to do is just nothing. We don't have to go up. We don't have to go down. We just go sideways forever. And it still looks good because we're above everything. We're in a bullish posture and we're not far off the all-time highs. Now, is that likely to happen? I don't think so, brah. But I wouldn't rule it out. All right, so S&P. So just for a note, the TDMACD looks exactly the same as the Dow Jones. The stochastics are no bearish divergence. We invalidated that by putting in a new high right here. And we also obviously put in a high here. So we have invalidated all the bearish divergence on the SPY. So that is obviously good. We got back to our target right here. Obviously, this is our target. And you're like, oh, we're already above the target. And you're like, no, we're in the target. So maybe we go a little higher. Maybe we already topped out. Who cares? We know that statistically speaking, when we sell resistance, And when we buy support, it typically works out well for us. So everybody else getting bullish now, buying into the strength right now, counter trend, because obviously we're in a bear trend. So what do we do in a bear trend? We sell rips. And where do we sell rips at? At resistance. And where's the resistance? Well, moving average is a pretty good resistance. Descending channel or broadening wedge is a pretty good resistance. Back test of support, that's pretty good resistance. Fib levels are pretty good resistance. So do we have any of those things? A heart line of a macro channel is pretty good resistance. Is there any of those things in this little like cluster area? Oh, what's that you say? All those things are right here in that cluster area? So, it's a shitload of resistance. It's all of the resistance is right here in this little clusterfuck? Oh, okay. So, I guess then probably we get rejected. But if we break above that, if we break above the 618, we break above the 200 exponential and simple, then what? Well, I would say probably off to the races. Now, could we come up here, put in another lower high? This, resistance right here gets broken out of, and then actually we just come back up to 786, and then we get rejected there, and then we come all the way back down, revisit the lows, maybe new lows, maybe a higher low. Any of that, obviously possible. But first things first, this right here is a clusterfuck of rejection until it's not. And then if we just go to our long time frames real quick, on the weekly, again, we see that exact bounce off of the 200 exponential, attempting to cross 821 back to the upside. All we have to do is just hang out right here. It looks good. All green histograms approaching the zero line. Slope is still red. Hard buy signal. Knife is aggressively angled to the upside, and the Stochs are on their way up as well. So are we building momentum to the upside? Yes. Is the trend still very bullish on the weekly? Yes. We just have to pay attention now to if we come up and put in another lower high. And then when we look at the monthly, again, we see just exactly what we said. We break down from here. It looks like we're going to cross. Obviously, we want to play the back test. It exploded back to the upside. We got our nut on like every crypto. And I take it back. Like a couple cryptos literally did nothing. But 90% of the cryptos, we got our nut on. We exceeded our nut. And same with stocks. They have like exploded to the upside. Great trades. Congratulations to anyone that has literally done anything in the last like month and a half similar to or what we have done, because it's been an absolute slay fest. And it's honestly, it's great seeing everybody in the group just absolutely crushing, and the amount of growth that is taking place, the amount of charts that you guys have been presenting that are not just like dead assets. Absolutely amazing. Matter of fact, we're going to take a look at those charts very, very shortly, because we have like, we got a laundry list of legit charts, trade setups, etc. of some really freaking nice stuff. And then also one chart that everybody else is like getting pretty bullish on that actually is really, really bad. Really, really bad. So that's like basically like a giant red flag to avoid, and then a bunch of like legit possibilities. Not even just for like little scalpy scalps, little like swing trades. I'm talking about like positional, like multi-year, decade trades with massive upside potential. Hopefully we get to them today though, but I keep dragging on, so maybe just next time. I'm just kidding. I wouldn't do that to you. So NASDAQ at resistance. It's the same thing. Obviously, there was no bearish divergence here. Blah, blah, blah. The NASDAQ. Blah, 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 blah. I don't even know why I look at these things. It's like the retarded cousin of the Dow Jones and the S&P. It looks the same. It came down slightly lower, got the 200 simple test, which obviously is better. That's what we wanted from every chart. But we got a little front run. Hard buy signal, leaving the bearish control zone. All green histograms, approaching the slope line, approaching the zero line. Very close to having 821 cross the upside. All it's got to do is hold on to the 12,400 level. But on the monthly, what is it really? Well, this thing just went into a short-term bear trend and an overall very bullish market, obviously, but backtesting the 821 bear cross. And essentially, what do we assume is going to happen right here? I assume that we're just going to get rejected. It's going to get its teeth kicked in, and the NASDAQ will be at new lows very soon. Does that have to happen? No. Hard sell signal. Stochs are powerfully angled to the downside. We do see the beginning of the signs of the blue Stoch, at least like not going straight down, directly to the center of the earth. At least it sees like a little curve right here, a little hook. We also see the knife aggressively had stabbed down, perfectly, identifying essentially what amounted to the bottom, and then aggressive move back to the upside. The problem is, this all happened so fast. The purple stochastic is still like way up here. And in order for the knife to technically give us like a bull signal, it has to cross above both stochastics for like a long-term trend resolution. And this stochastic is going to take like months to get down here, while the knife is taking like months to get up here. So like, when is that going to be? It's like, oh, great. So in November, we'll know if this is like a sticky bull trend on the monthly. Awesome. Great. But I mean, it is what it is. So, trading the monthly, not going to get like timely results, but they're going to be reliable. So obviously we saw very clearly, this was our first time we ever crossed the 821 to the downside in the last, 14 years. And look at what happened the last time. Okay, so here we're in danger. Here it's going to look like a cross. Here it's like, oh no, we're fine. Everything's great. We're going back to the upside. Here it's like, yep, confirmed. Back to the upside. Bull trend resumes. And then it's like 3, 2, 1, boop. And then it just goes straight to zero. Well, I mean, towards zero. Doesn't get all the way there. But so, is this going to happen again? I mean, I wouldn't rule it out. Doesn't have to, but I wouldn't rule it out. So that is our NASDAQ. So we're going to look at the Russell. So the Russell, again, just being our bitch. So we had basically said we're looking for this macro, push down here to the 382. We come down to the 382, and then it's like, okay, we're going to go to the lower fib, the higher fib. Obviously, we go to the higher fib, and now here we are, choose your own adventure, and now we're at the 236, and it's like we're going to go to the, back to the upside or to the downside, and you're like, oh, it's a Russell, so obviously it's going to go down, to which I would say, you're catching on. But we could be wrong, in which case, maybe it gets the measure move to the upside, whatever. But what do we see here? The Russell's in a bear market, rejected, lower lows, back up here. What's happening now? A high, a low, a lower high, a lower low, a lower high, until we take out this high right here at 21,300. No, that's not the one. 2,134. We can't obviously say like we have potentially broken the downtrend. So is it possible this is just like a massive uptrend, consolidation, breakdown, and then we're going to go to new all-time highs? Sure. Definitely possible. And you're like, let me explain to you the fundamentals that take us to new all-time highs. To which I would say, let me go get my popcorn, because this is going to be fucking good. You're like, money printer go burr. In which case I would say, oh, never mind. You're right. So Russell on the daily, back testing at resistance. Looks very, very likely this is where it rolls over somewhere in the very near future. Russell on the weekly, pathetic, reclaims the 200 exponential and simple. This is why we don't want to get bearish immediately. We want to wait for a back test, a lower high, and a fail, or a back test and a rejection. And then that's where we, basically want to be selling the rips. This is still technically bullish. That's why at least the first time, we come down to 200 exponential and simple. It's a buying opportunity. And then what happens after that, we pay attention to. We put in new all-time highs. It's a great buying opportunity. If we put in a lower high, it's a great selling opportunity as well. But here we see very close on the weekly. The 821 have crossed the downside. We saved the 200 exponential, very close to the 821 crossing at the upside. We're at horizontal resistance. We are at our channel resistance. We're just at so much resistance. Definitely building up some strength here on the weekly for the Russell. And, does that just mean all of a sudden all these companies that are barely able to service their debt, that are going to be like refinancing going into the future, are okay now and they're just going to make money? Does it mean now they're going to be able to pay down that debt and they're not just going to make interest payments like some idiot that ran up $100,000 in credit card bills and just pays the minimum payment every month? Wouldn't count on it. I don't think people suddenly are like, oh, now my business is great. I mean, some are for sure. Some people are definitely killing it. But I would say the majority of trash bag companies in the Russell that are like not profitable or barely able to service their debt at record numbers, probably like not the best place to like invest your money. And you're like, yeah, but the upside potential. And I'm like, yeah, but the downside potential. And you're like, oh yeah, you're right. So Russell on the monthly, back testing 821 cross. We had a couple other times we did the same thing. Not as reliable as like the Dow or the NASDAQ or something like that. But, aggressively trading to the downside, trying to find some support. Knife is still well away from crossing above the purple Stoch. All red histograms, red slope line at the neutral level, trying to bounce. One green histogram. So time to get bullish on the Russell? Yeah, I don't think so, brah. But I mean, we're close. Shit. I mean, we're bullish down here. Everybody else bullish up here. And we always dump on people's heads. So does it seem likely we're getting ready to dump or have been dumping on people's heads? Or does it seem like everybody else is right and it's definitely not like FOMO after a nice rally off the lows? Guess we'll never know. Or we just wait and see. XLI, so pretty much all these indices. So we know what's going on here. Obviously with all of the major, or the sectors rather. Industrial, nice rally off of the lows. Backtest of 200 exponential and simple. All the charts are in varying levels of the same thing basically. We have invalidated like 90% of the potential bearish divergence. Just about everything has backtested 200 exponential and simple. That is like okay. The stronger sectors are above the 200 exponential and simple, and the absolute garbage trash sectors that no one wants and will probably just trend towards zero for much, much longer are like still down here consolidating at the lows because they're trash and no one wants them. So industrial, mediocre, somewhere in the middle, likely to get rejected around this area. XLF, financial, a little gap up here. This one still has potential bearish divergence. So we got to be careful of that as it's still putting in a lower high. Obviously, it's massive underperformer, which is crazy. I mean, who would have guessed that the financial sector is actually complete trash? I mean, I can't think of a single person that's been saying that for literally like the whole entire way down. Oh, I think it was Greg Manarino, actually. Oh, no. No, he was saying he was buying banks at the top. Oh, that's right. That's right. You're right. So clearly a bear trend. This is the first backtest of 200 exponential and simple. Does it get there? We already got the hard sell signal. Is it rolling over now? Is it going to come down here and fill the gap? Doesn't matter. All we know is this is like weak, definitely bearish, and one of the worst sectors. Next we have essentially, I mean, what is this? Same chart. XLB materials. Same thing, basically. Looks almost exactly the same. Still no bearish divergence on this one. Potential bearish divergence on the histogram, but not on the, oh wait, was that higher or no? No, it wasn't. Not on the stochastics. Now it is possible it goes back up, puts in a new high, prints bearish divergence, and then rolls over. But it's basically just a back test of the horizontal, what was support as resistance. So people are like, yeah, let's get bullish now at resistance. Or is everybody else thinking the same thing as us? Let's dump on everyone's head at resistance, right as they get the most bullish. Probably smart money is doing what I'm doing, if I had to guess. Or should I say, I'm doing what they're doing. However you want to look at it. We're doing the same thing. XLY, consumer discretionary. Again, same back test, 200 exponential. This one's like decent, holding up okay. One of the more neutral ones. XLC, communication, the trashiest trash to ever trash. And you're like, no, not ever. And I'm like, yeah, bro, ever. And you're like, no, there's got to be one worse than this. And I'm like, okay, there's probably a couple worse, but this one's pretty fucking bad. So yeah, just hanging out at the lows like a trash sector that no one wants anything to do with. And you're like, that's because there's massive opportunity. And I'm like, sure there is. Sure there is. But what are you giving up for that massive opportunity? Probably a lot of time. Pathetic. I mean, just absolute trash. Garbage. Hanging out at the lows, doing nothing. Not even close to 200 exponential and simple. Not even close to like making people excited. You're like, yeah, but the 821 crossed the upside. It's trash. Garbage. By far the worst. XLK Tech back here in between. So neutral, still bearish, obviously. Back test. This is our technical first back test since we confirmed into the bear market. So what is likely to happen? Well, we come up here, try to put in a higher high, fail, get rejected at key levels, and then roll over and go to likely new lows, possibly a higher low. We'll know when we get there, but still very much a bear market, but neutral bearish. It looks okay. After the move has already played out, after we have already crushed the market, should we get more bearish now or more bullish now? Obviously bearish. Should sell the rips. Sell the rips. In bear trends, we sell the rips. In bull trends, we buy the dips. Just say that over and over and over again. And then all you have to do is just say, so are we in a bull trend? Or are we in a bear trend? And you're like, oh, that's easy. Bear trend, sell the rips. I know. You're like, that's so easy. What do I need you for? Nothing. You don't need me for anything. I could save a shitload of time if nobody needs it anymore. Just let me know in the chat, and we don't even have to do any of this. Once you guys are maxed out on knowledge, we can just wrap it up. XLRE real estate, again, beautiful trade to the downside, hit our targets perfectly, boom, back up here, back testing. What is this one? Neutral, garbage, rolling over, yeah, we'll see what happens, but neutral to bearish. So XLP, consumer staples. So now we're into the good stuff. Obviously, reclaim the 200 exponential and simple. 200 simple is above the 200 exponential. So we see the trend is weakening. Does not mean we can't put in a new all-time high. Does not mean we can't continue trending to the upside, but it's worth paying attention to that typically when the 200 simple crosses above, that is our first strong signal of a top. Now, again, it doesn't mean we don't go to a new high before that, but it's a very good indication that we're probably topping, or if the opposite happens, which we're going to talk about a little bit later, when we're bottom feeding, we're getting our sucker fish on, okay, we're cleaning that algae off the bottom of the pond, looking for those value stocks, in the word of Kathy Wood, that deep value territory. We're looking for the opposite, basically. The 200 simple to cross below the 200 exponential, saying that we're losing momentum to the downside. So that being said, again, looks okay, looks better than most. Are we going to get rich off this? Is it going to go to new all-time highs? Probably not. Is it going to preserve your capital better than just about any other sector in the market? Ding, ding, ding. Especially if we go into a recession, which we might already be in. Maybe we are not, but we're going to find out eventually. So again, that's why we're seeing that strength, is because that's, historically speaking, a safety play for the closest you could possibly have to our environment, which obviously is just 1 in a million. And we're just super lucky, okay? I mean, if you ever heard that old Chinese proverb / curse, may you live in interesting times. You're like, oh, that's not so bad. And you're like, no, that's like a curse. We don't want interesting. We don't want that. I don't want interesting times. No, thank you. I'll just take the easy regular. I'll have 1 easy regular times, please. Oh, you're sold out of those. Okay. Well, what else do you have? Oh, just either interesting times or really shitty times. Well, how shitty? Oh, all right. I'll take interesting. That works. So we talked about this one, XLV healthcare, and the potential of this weird inverted head and shoulders bottoming pattern. We're at resistance now. Resistance obviously lines up with 200 exponential and simple, which are still blue. 200 simple is above. We see here is a perfect example. 200 simple crosses above the 200 exponential. We put in a high. We backtest those. The 200 simple continues to trend above the 200 exponential. We actually put in another high after that. So you're like, well, how useful is that if we put in 2 new all-time highs? Well, it's more useful than nothing, but it's not going to like pick the top perfectly. But then obviously we see on a long enough time frame, eventually it plays out. So again, back testing here. If we break above this level, we likely revisit the highs again, maybe a new all-time high. But realistically, what does it look like? This looks like our initial back test. We confirm into the bear market, we get an immediate back test, we go to a new low, and then we're really like, okay, but are we really bearish here or no? Like, could go either way. Is this another back test? Are we just confirming back into a bull market? We don't really know, but it's worth paying attention to. So bullish more than most. XL utilities, aka the XLU, already almost at the high, absolutely just ripping to the upside again. Key safety play. Maybe you don't get rich, but it's definitely doing a great job preserving capital, better than just about anything else in existence, especially for the amount of risk you take. And you're like, yeah, but I could buy blah, blah, blah and be way up. And you're like, sure, you could buy energy and be way up, but also energy like cratered like 30% in a month. So, that's your big difference. Like when utilities crater, we're talking about, and I mean, when I say crater, I'm talking about losses, okay? 14%, that's game breaking. No, that's not bad at all. I mean, especially if you're in the crypto markets, because you're like, I can do that in 15 minutes this morning. So XLU, likely goes to new highs from here. There's no reason to think it doesn't. 200 simple cross above, 200 exponential getting ready to cross back above. This thing looks juicy. It looks like it's ready to rip. Obviously, we still have that macro target. We're back at the heart line again now. we still have that macro target to the upside. I mean, I know it's crazy, but you know, this was from way back here, like ridiculous upside potential. And you're like, we'll never make it that high. And now you see, we're like, oh, we actually almost already did. And then like really, because it took so long to get there, like the actual top we're looking for is like way higher, 85. So, you know, again, we'll see. Not going to get rich off this, whatever, but worth paying attention to. Definitely by far the strongest sector. Well, I don't know. Depending on how you look at it, you could argue that energy is stronger, but just not right at the moment. So XLE, energy, obviously phenomenal. Bouncing 200 exponential and simple. Very close to 200 simple, crossing above the 200 exponential. You know, we took a pretty deep dive into the oil chart and everything. So we see what's going on here. We don't see any like clear bearish divergence or anything like that. So essentially, we're just looking for like an initial bounce off this level. 821 have crossed back to the upside. And then what we're going to look for is, you know, where does the internal retracement go to? So our target was obviously, you know, from the top to the bottom, somewhere in between the 1.5 and the 1.618. We hit the 1.5 already, and we were presuming that that could potentially be the top. But what we were talking about was exactly what happened. What we want to see now is we have a low, we have a high. So we want to see a back test, and we want to see a higher low, at which we got. We also saved 821. So it seems very likely that we're headed up here to the 618. Now, does that mean we're going to like be able to grab a little scalp off of this? Not really. I mean, with a 7.5% upside to the 618, you really have to like run a super, super tight stop loss or already been in the trade. But realistically, you know, what if it just rips through there and goes to the upside? You know, you just, you know, buying into momentum, that's fine. What if it goes right up here, tops out, and then, you know, you get cocky and it rolls over? Again, could go either way. I wouldn't rule out that it's just going to come back up here slightly higher and top around like 81. And really, I'm looking for like the big value plays lower on energy. Does it get there? Maybe not. You know, we'll have to wait and see, obviously. But hard sell signal, red histogram. I'm sorry, red slope line. We're above it. We're above the 0. You know, we're bouncing 200 exponential and simple, and we're doing it for the first time in a long time since December 2021. So likely we get a good bounce off this, but the question is, did it already happen? And I would say the majority of it already did. When we get to the 618, we'll see. And then if we have to reevaluate and buy into strength, that's completely fine. If you wanted to look for, like, basically, if we take out one of these key levels and run a super, super tight stop loss and look for, like, the continuation upside, I would be shooting for higher than the 618, but I would be locking in gains at the 618 just in case. XTN, transportation, back test of 200 exponential and simple, you know, bullish neutral, whatever, or bearish neutral rather, whatever here. Technically invalidated the bearish divergence. That is definitely a good sign. XSD, semiconductors. So again, looking pretty top here on the back test of the 236. Rejected off of the 200 exponential. Excuse me. Topped at the 0.5, came down to the 382. So again, we just see a series of higher highs and higher lows, working our way up here to the 618, working our way up to the 200 simple, working our way up to the right shoulder of the head and shoulders. I don't know, but I wouldn't want to be on the other side of this if it breaks to the downside. So we'll see. I mean, hypothetically, obviously, I put this in way ahead of time. Doesn't have to happen, but, you know, it's worth paying attention to. All right, so now we're into the good stuff. Okay, so we got all of our, well, there's a couple commodities. This is one of my trades, and there's a bunch of other stocks we're going to look at. We'll touch base on crypto, but nothing has changed in crypto. We already know what the upside potential targets are. We already know we're in upside, so we will try to get to them. We still got an hour left. We should do fine. Depends how deep we go on the request, honestly. So ICLN. So this is a clean energy ETF. I was interested in it. Basically getting back into it at some point in time. And, you know, as crazy as this chart is, this is our old chart. As crazy as this is, you could go back like, I don't even know, 8 months ago or something like that. and this was like our target setup and everything. So this obviously was not in place, the red swing low right here. But basically we were looking for the retracement somewhere in between that level, and then this was like the potential trade setup. So we basically have reclaimed the 200 exponential. We're at the level, you know, essentially. There's some pretty strong tailwinds, you know, with this new, like, you know, clean energy, inflation reduction, all this like bullshit spending that's about to go down. So maybe we're topping out at another lower high. Maybe there is some potential for this thing to rip and roar. But when we zoom out and look at the longer time frames, basically in a massive parabolic uptrend, we had a back test here. We rolled over, shot up to highs, back test here, found support perfectly on the weekly 200 exponential and simple, you know, and obviously our, you know, bull case for this since way back when. And I'm telling you, we drew this chart like, I don't even know at this point in time, a year ago, 9 months ago, when it, like after this thing was topping. What was that? January 2021. I mean, it's been a while when we drew this, and we're looking for the breakdown to our target. So once we got to that macro 0.5, we were looking for essentially the internal retracement. Obviously, we could draw it the other way around, but we're looking for like an internal retracement to those key levels. We saw key resistance and support at the 0.5 on the way down. Here we see essentially that level acting important and headed towards the 618 on the way back up, which obviously is resistance. We could top out there or around there. But if I'm right about what's taking place right here, we have a 1 wave up, 2 correction. We have a 3 wave up, 4 correction. You know, we obviously come down and back test the 200 exponential and simple here and go parabolic. Maybe this isn't even a leg up, and actually this should be the 1 and that's the 2, and this is the 3 and that's the 4, and then we're putting in a 5. Doesn't matter either way. I honestly don't really care. I mean, if this is the case, it doesn't really change like anything for us. It doesn't invalidate, you know, the move. It's not it's not perfect looking, but, you know, the 1 tops out, the 4 comes down, they don't overlap. We have, obviously the 3 is longer than the 1, so the 5 could be any length. You know, everything looks pretty good here. So the only thing I don't like is the depth of the retracement on this. It's basically like a 100% retracement. So you almost have to use like this low to do it. And then it's like, well, really though, are you just drawing the chart wrong? And really this is just how you draw it? Maybe. I mean, I would say yes, but it is what it is. So something along these lines, you know, whatever the actual low is, somewhere around there. But essentially this is what I'm looking at. What does that give us, and how do we come up with this trade setup to the upside? Well, we obviously have the previous all-time high. So this time we made it up to almost the 786 and fell short. So you would think we'd make it to the 886 or possibly a retest of the previous high, you know, which is basically when this came out. What was that? 2008. So we have a good like 14 years worth of data. And then alternatively, the other option is, you know, obviously we have from the high here to the low here, fib. And then we have the internal retracement to the 0.5, potentially the 618. Maybe it tops out and rolls back over and goes lower. Or we continue to move to the upside, and then our target is a 1.618 Fibonacci retracement, or Fibonacci extension. So that gives us roughly a target of like $54 to $60. It gives us a stop loss if we break below the 0.5 of 14.8%. Gives us a upside target of 142%. And it gives us a risk reward ratio of 9.6 to 1. And you're like, well, that's not bad. And I'm like, yeah, I know, right? And you're like, yeah, man. And I'm like, yeah, man. And you're like, I know, I said that. And I'm like, I know, me too. And then it just gets awkward. There's a little silence. And then we just kind of shake our heads. And then we wait. And then we wait. So yeah, there's a high, there's a low, there's a lower high, there's a lower low. When are we going to confirm that we have like broken out of that little situation? I mean, you could argue that was our boy right there. That was daddy. Daddy's home. And obviously that's what I was looking at. So yeah, again, obviously, you know, do not take any trade setups we discuss on stream because they're all just a trick. And the second you enter that trade, I will immediately dump trillions and trillions and trillions and trillions and trillions of dollars directly on your head, because this is all just a trick, and I'm just using you guys for liquidity because I'm a massive whale. Or literally none of what I just said was true. So obviously. But yeah, ICLN, baby. It's definitely a thing. It's a thing. Could go to zero though. But I mean, there's some strong fundamentals with the big corporate welfare slash spending slash whatever you want to call it stuff. All right, so blew through all that, and by blew through I mean we made it. So let's, man, should we do crypto just really quick? Let's just do Bitcoin, Ethereum, and Bitcoin dominance, and then we'll do all the requests and stuff. So we just get this out of the way really quick because there's not much to say right here. Because it's just doing what we've been saying was going to happen, and it's like, oh look, the thing that we said was going to happen is now happening. And you're like, oh, it's crazy. Bitcoin futures, you know, just a slightly higher high. Obviously, some key resistance right here. Looks good, obviously, that we're trying to push above there. Could get rejected and come down. Still going to look like a horizontal resistance. Still going to look like, you know, something like a ascending triangle that likely we break out and back test like somewhere around like 26 to 28K levels. Maybe come up here, fill the gap. It's literally everything we've been talking about. And you're like, but it's happening. And I'm like, I know, right? It's crazy. And you're like, but TA is still fake though, right? Right? And I'm like, sure it is. Sure it is. Bitcoin futures on the weekly, you know, back testing, trying to get reclaimed 200 exponential and simple. Still bullish for time testing them. Obviously good, hard buy signal, bunch of green histograms. Looks good for a breakout right here. The thing I don't like is typically when we get like these hard buy signals or we leave the bullish control zone, we get like a powerful explosion to the upside. And the 821 usually like are about to cross or cross immediately after. Here we see the same thing. Nice little explosion to the upside, very close to 821 crossing. Look at the gap between the 821 right here. We literally have to get back above 28.5 just before we can even start looking at the potential for like the cross to happen sometime in the future after that. So by the time we get a bull cross on this, we're going to be at like 34,000 or something like that. So if we get a bull cross on this, basically like our base case is invalidated because at that point in time, we'll have come back up to what amounts to the bottom of the 1, the top of the 2, the bottom of the 3, the back test of the 4. So if that happens, if we start confirming legit back into an uptrend, I mean, there's no doubt in my mind at that point in time, you know, it's off to the races. And, you know, obviously full disclosure, we've taken some profits along the way, but we're still long, blah, 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 blah. You obviously know that. Bitcoin futures on the monthly still looks like trash. Cross the downside, absolute garbage. We're in the bearish control zone, and this is what everyone's excited about. Just this right here. Just a heads up. Just to make sure everybody's on the same page. Nobody gives a shit that we dropped 72.8%. No one cares about that. Not at all. But what we do care about is that after we went down 72.5%, we went up 30%. And you're like, well, that's good. We're halfway there. To which I would say, well, not quite. The problem is that if you were some newbie and you bought the top, or even if you just happen to look at your account balance at the top and you're just like, oh yeah, I'm just trying to get back to like, you know, the $1 million mark or whatever. So I'll just wait to get back to there. Well, you're still down 65%. So you're like, what? You just said we were down 70% and we went up 30%. How can we down 65%? Exactly. So is this worth getting excited about right now? Or are we just like in the process of just doing this? We don't know for sure. Is this right here? And then it'll bounce up before we just capitulate? We don't know for sure. Are we going to get all the way back up to 34K and back test key levels and try to cross this back to the upside? It could happen. We don't want to get overly bearish on these charts, but we also don't want to get overly bullish, especially after we take counter trend scalps that have already played out. All right, so our spot chart, do we need to do anything special here? I don't think we do. We've been through this a gazillion times. No one knows what's going on in this chart at this point, including me. There's just too much. There's so much shit going on in this chart. I can't even read it anymore. But, you know, obviously we have targets to the upside. The target, the trade setup, the one that we're in currently, or technically it's 2 that we're in. But 28,000 is our target to the upside. And that's going to give us that, well, depending, because we entered part of the position down at this one, and then we entered again at a lower entry. So we're looking at somewhere between 25 and 35%. So call it 30%. And then obviously we know that our target we know what the red box is. That's the we're right again box. So if that's resistance, that's our target to upside between the 0.5 and the 618. That's also our back test right here of the maximum area we can go to, 34,000. So essentially, we want to start taking profits throughout this range, anywhere from like that 26,000 range. We have another step at 28,000, and then we have another step at 34,000, roughly. And then if we go higher than that, again, we're breaking out of this downtrend. But look right here, and I know you're not going to be able to see it at all, but let me just turn this off. Imagine just if there was a line going from this high right here to this high right here to where we're potentially expecting a potential high right there. Just imagine. Now, with your imagination and also your eyes, try to see the line that's actually doing that. It's this green line right here, okay? Or arguably this little red dotted line. But that's a peak right there. That's a peak right there. Just so happens that's our 1, that's our 2, that's our 3. And we're estimating, obviously, timing is very, very difficult to do. And why even worry about timing when you can just be like, oh, are we going to go up or down? Well, I don't know. People like to overcomplicate shit. Obviously, it's human nature. But timing would tell us that we're probably going to hit the 200 exponential, the 200 simple, the 618, the descending resistance, and all that good and juicy stuff on roughly August 22nd. And you're like, wait, what? That's like 12 days from now. And I'm like, I know, right? And you're like, not this again. And I'm like, I know, right? And you're like, no, seriously. 34% from where we're at for shitcoin master, the biddiest, the shittiest, the golden deuce of crypto. Bitcoin. No, that's not it. It's Bitcoin, not BitConnect. So yeah, that's what we're looking at. Are we going to be right? No, I'm sure it's just going to roll over and go to 0 or just go absolutely parabolic. But, you know, maybe we'll just get lucky one more time. Which I could see us getting lucky one more time. But after that, we're really pressing our luck. So Ethereum, the trade played out. Obviously took profits early, put it into a bunch of shit coins. It wasn't working out particularly great as shit coins were literally doing nothing. But obviously over the last couple of days, they have, let's just say we got our nut. So Ethereum hit our target finally. It was the super easiest trade ever in all of existence to take. To anybody that ever saw this, it broke out before everything else. We charted it ahead of time. We talked about why this was the best trade to take. We talked about why Ethereum is blah, 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 blah. And that's it. And obviously it worked out perfectly. So now here it is. We bounced from the 382 back to the 236. We had a 76.5% motherfucking move to the upside with a beautiful, beautiful setup. And now it's done. 11 times risk reward ratio. So are we going to get bullish now at resistance? Are we going to FOMO in to try to capture that last little couple percent to backtest the 200 exponential and simple, backtest resistance? Are we going to do no. When we hit our targets, we take profits, and then we sit back and relax. We enjoy the W. We don't just say, oh, we took it too soon. Now it's going to run away without us, and we'll only be able to afford to buy 10 Ethereum instead of 12 or 3 instead of 4 or whatever it is. No, because we don't give a shit. Because I don't care how many Ethereum I have. Just like I don't care how many Bitcoin I have. Just like I don't care about any of my stonk or anything. I'm not like, oh, thank God I finally have my 100th Apple share. Oh, this is amazing. No, who gives a shit? I don't pay my bills in apples. Apple stock, not like actual apples. Well, actually, neither one. I don't pay my bill in apples or Apple stocks. So, yeah, but you know that. All right, Bitcoin dominance on the weekly. So it's starting to do what we said. So we're starting to get this big, juicy red candle. Obviously, that was not my base case, but once we lost the key breakout resistance, once we lost the key support, brap, that was a wrap on the back test. 821 crossed to the downside, took out the low right here. This is like that. I mean, there's no arguing what's happening here. We're headed back down to the lows. So what did this chart tell us? Well, it told us that we were right a bunch of times, and then actually we were wrong because my base case was we would backtest this and then go up again. But that didn't happen. So we were able to reevaluate and say either we're wrong or this chart is telling us something that's about to happen in the near future and we can take advantage of it. And what was that thing? Well, the thing was that shitcoins were going to outperform Bitcoin. And how did that work out over the last few months, weeks, whatever? Well, it worked out fucking perfect. Okay. So yeah, the shitcoins were the place to be for sure. Obviously, Bitcoin was okay as well, you know, but whatever. So yeah, once again, the Bitcoin dominance chart, just like that gold silver ratio chart, just like all of the other, you know, weird kind of charts that we look at, gave us a huge advantage over the market, telling us what was going to happen before it happened. Total crypto cap looks okay. We have reclaimed the 200 exponential, which is definitely a start. Looks likely we will retest the, I might have said the wrong thing, but I meant the 8. Looks like we're about to retest the 21 at about 1.25 trillion, which is definitely good for crypto. It is also the back test of the previous lows right here. So likely going to be a very strong resistance. And we probably, well, we don't know if we're going to get rejected yet. We'll have to see. But, you know, it's starting to look like 1, 2, 3, 4, all the way back up here, 1.6 trillion, maybe not. And then 5 lower. You know, it looks pretty clearly like the Bitcoin chart. And we're just kind of marching our way down. Is it possible we already did an ABC? Sure. But we have been through this like a million times about if this was actually the peak like we expected and we went into our, you know, unorthodox correction, then actually, you know, we would expect 5 waves down and not just an ABC correction. And we did the actual breakdown on Bitcoin like 100,000 times. And, you know, you can see the same thing essentially right here as well. So, you know, we see obviously a B, a C, then an a B, a C, then a 1, a 2, a 3, a 4, and a 5. You know, and obviously those are all part of the expanded Elliott wave flat correction pattern. All right. Avalanche, majority of the trade setup looking good here. Solana, a dirty dog. Dirty dog. Solana's garbage. Obviously, you guys know that I have been kicking Solana's dick in for some time now because it's absolute trash. And it is. It's absolute trash for sure. Like, you're like, oh, why is it trash, man? It's not like they got hacked. It's not like they reversed transactions. It's not like they took people's crypto from the wallets. It's not like it's highly centralized. It's not like literally everything that you could possibly imagine and write down on a piece of paper for like shit that makes you not want to put your money in it. Oh, it is all those. Oh, okay, yeah. So just any other crypto, okay? But that one. And by any, I mean off of like the top 20. Don't be buying shit. So Polkadot, first target almost hit here. Still have massive other targets to the upside. Basic attention token, just a fucking dog. Just does nothing ever. Also an advantage though. And actually the chart looks better than most. Link, beautiful. Got our nut. Busted that nut. 48%. Killed it. Matic, I don't know why Link has been one of the like top performers though. Matic again crushing it, almost up of 50% on that one. BNB slaying, backtest at 200 exponential and simple. One of the best looking cryptos short term, one of the worst looking cryptos long term. And then last but not least of the crypto connects, we have Atom. Atom trade 44%, already you know, deep into that trade for now. Definitely some potential for like the big boy. 75% upside, but the truth is at this point in time, you know, once a trade moves in our favor, obviously we don't want to pull a Tesla and move our stop loss like too close that like we get stopped out or we have to violate our rules. We don't want to do that, but at the same time, like we also don't want it to come back down here, stop us, or and then put us upside down and what was a winner. I'd rather get stopped out and then it moves in our favor and we're like, damn it, which is like the Tesla situation, then it comes down here. We turn a winner into a loser, and then, you know, eventually you just have to take the L or, you know, get stubborn, and then it keeps running against us, and then we don't take the L, and then we end up much worse. But, I mean, 10% on that one. So, yeah, that's it for cryptos. All right, so let's get into the juicy stuff. So, congratulations if you made it to the juicy stuff because it's super excited, so. Adam WJS says, sell the rips. Yes, sir. All right, so gold, still not looking particularly good. Looks like it is pretty tired here. Back testing resistance below the 200 exponential and simple. It's been a pretty choppy run right here, but we know on longer term time frames that gold absolutely needs to reclaim some key levels. Right now, it looks like a back test rejection, and we likely go lower. But when we look at the old monthly, it looks almost exactly like what took place here. We break down from the 821. We backtest the 21. We do not reclaim it. So what does that mean? We absolutely need to claim, close this monthly candle above 1800. If we close below 1800, I mean, we are very, very likely going to get a situation like this. A nasty, dirty capitulation that lasts for years. And you're like, but gold and the currency with the Russia and the China and the US dollar is garbage. And I just don't care because the chart. And the charts are always right. But you could say like a bunch of narratives that aren't right. And you guys know that. You know that. I like technicals. I like fundamentals. But in the end, let's be real. For short to medium term, technicals destroy fundamentals. For long term, fundamentals are good. GDX. Okay, so we're looking at the VanEck Gold Miner ETF. Okay, so this is the Gold Miner ETF. There's also GTXJ, the juniors, not to be confused. So what are we looking at this chart for? Well, we're looking for some opportunity here. And then also we're looking for some clues as to what's going to happen with gold. So let's just take a quick look at this one. We're going to rip through here. So we have a high, we have a low, so all-time high, all-time low. And then again, we started marching to the upside. 1 time up, 2 down, 3 up, 4 down. The 4, though, potentially, what we would look at as a 4, came down inside of the 1. So we can't look at that as a 5-wave upside that would potentially have another wave. So invalidates a potential Elliott wave because the top of the 1 and the bottom of the 4 interact in an undesirable fashion. So that being said, 821 are crossed to the downside. We don't have 200 exponential or simple populated. So what do we want to do? We want to look at some fibs and we want to look at some resistance and support. So we have something along these lines for a resistance. And then for a support, we have from basically the lows back here, and then some kind of support line right there. And depending on how you draw it or what happens over the next couple of days, you could argue that from the bottom, the higher low, and then potentially we're breaking down from this level. Now, we could easily reclaim it, likely go back to the top of the range, shop around, but soon we're going to get a massive break in one direction or the other. Could that break have already happened and it's about to just capitulate? 100% yes. Now, let's look at the indicator oscillators on the monthly and see if they're telling us a clue right here. So we have the peak right here, that high. Bunch of red histograms. We lose the slope line. The slope line turns red. We push back to the upside. The slope line turns blue while we're underneath it. And then we get rejected. What is that? That, my friends, is the most reliable rejection signal that we could possibly get from this indicator. This is the master of rejections, okay? Like, think of some time where you just poured it on some beautiful female and just spit your game like you never spat before, and she just shut you down like you didn't even exist. That's what just happened right here. So, or guy or whatever, I don't know what your interests are, or if you're a guy or a girl, I just assume that you're probably a guy, and but you can substitute gender or whatever it is that you're into. Rubber doll, I don't care. So GDX, definitely some warning signs from this bad boy. Definitely some warning signs. So, we'll have to wait and see what happens over the next few days, weeks, months, but red flag. And you're like, wait a minute. So you mean to tell me that the spot gold chart looks super sketchy, like some shit could hit the fan, and then also the GDX gold miners chart looks like that shit could hit the fan? Bullish. Probably not. So obviously back test the 786 from the high to the low. That's a key pivot. We saw a key pivot at the 0.5 as well. Key pivot at the 236. Key support and resistance at the 382. Key support at the 0.5. Key resistance at the 618. Trading very, 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 very technically. So a breakdown from the 0.5 likely takes us to the 382. If we break down and go to the 382, we will be breaking out of this pattern, and we likely see some serious capitulation taking place. And you're like, if only there was a way that we could figure out what the measure move would be. And you're like, oh, well, we just turn our ascending support into a makeshift channel, and then we take the move from the top of the channel to the bottom of the channel, and then we say, here's your sign. So if this does break down, what does it do? Well, it likely revisits the lows, but I mean, could get nasty. Could get very, very nasty. So you're like, so that's an opportunity, right? I mean, there will be opportunity in the future for gold miners and gold. But in my opinion, the opportunity is not now. Now, there is a possibility that we find support here, reclaim this level, get back above the 0.5, at which point in time, there's potential for a nice little scalp back to the top of the range for like 35%, which we will be taking advantage of if and when it presents itself. But the first and foremost, we need to reclaim this level, and then we need to get back on top of the 0.5, at which point in time we'll look for an entrance. And by the time that happens, let's just say it kind of chops up here a little bit and does what we said, then we will look for that trade setup from the 0.5 with a lower low close stop loss, which would be like, basically if we close below that candle right there. Now, please keep in mind, this trade setup is not active yet. And also, it could literally just roll out here. It doesn't mean we get stopped out. It needs to get back above the 0.5, consolidate, and get back inside of this ascending support. And that is when, once we get back here, we take our entry. And then the entry to the upside target, obviously, will be like 33%. You could argue, well, maybe we'll just go to the 618. That's 22%. And then obviously with a stop loss at $2.41, 8.43%, with a upside target of 34%. With a target of $38.31, risk reward ratio 4-to-1 in what is a overall bear trend. So are we above 3-to-1 risk reward ratio? We are. Is this a valid trade setup? Well, if all of those things happen, we get back on top of the 0.5, we hold the support, then we can look at it. But realistically, what's probably going to happen is just a big nasty dump. Big nasty dump. I mean, that Taco Bell dump, if you know what I'm saying. That gross. Does look like on the daily, though, that it wants to find support, reclaim the 821 crossing back to the upside, momentum in its favor, buy, sell, buy, divergence signal. So are we going to get that nut? I mean, we don't know. We don't know. But there's a very high likelihood if we close back above those key levels that the trade setup will play out, and then we'll take advantage of it. Now, it could get rejected here, it could get rejected here, it could get rejected here. We'll have to be paying attention, but there's definitely some potential for this. But it could be potential to the upside or potential for like much, much lower prices. So silver, again, looked like trash. Breakdown, new lows in the teens, backtest in the 20s, as expected, momentum in its favor. When we switch out to the longer, obviously still bearish, but we switch out to longer time frames, backtesting the 200 exponential and simple, essentially just confirming into a bear market or very close to. Not cool. Not cool. Silver looks like, say it with me now, trash. On the monthly, bouncing 200 exponential and simple in the bearish control zone, exit the bearish control zone, very close to an 821, or I'm sorry, a hard buy signal. So is there potential this is bottoming out and ready to just skyrocket to the upside? Sure, it's possible, but I don't know, man. A bunch of red histograms below the slope line. We got the hard rejection back test. The slope line rolled over, all red histograms below the zero line, red slope. I don't like it. I mean, are we going to come down here and take out the lows of like $13? Probably not. But is it possible? Yes. Yes, it is. And you're like, silver will never go to $13. You're stupid. Unsubscribed. And then finally, for the miners here, I wanted to look at the silver miner ETF as well. So this is SIL. Again, there's a junior miners as well, SILJ. It's got a massive amount of... oh my gosh. Massive amount of brain farts. Nope, that's not it. Dear God, I can't even think of the name of it. Yeah, okay. It's like 50% blah. I can't think of the name of it. One of you guys probably knows, but not going to wait to find out. I keep wanting to say Endeavor, but I know that's not it. So what's going on here? Let's look at this one real quick and see if we can get another clue from our silver miners. Obviously they're more bearish than the gold miners. So let's just cut to the chase here. Obviously we have essentially the same type of thing going on here. We break out, try to get out, we can't do it. So is it supposed to be drawn like this? Maybe. Is that useful? Not really. So we'll put it back right here. And then you're like, okay, so it looks like we broke down, we broke out, we broke down, we lost support, and now we're back testing it. That doesn't look good because probably we're going to get rejected. And then you're like, well, what if we draw the same thing on the bottom here? And you're like, okay, close, wick, close, Obviously, big nasty wick outside of it. And then you're like, oh, wait. So we broke down from it, and then we're back testing it as resist. Oh, okay. So this is double resistance. So we drew 2 lines on the whole chart, and they intersect at the exact point that we're likely to get rejected, which is like basically where we're at right now. Huh, that's weird. But also could be useful to not get kicked in the face by silver miners. Is it trading technically? No, not at all. Oh, wait, no, 100% exactly. I mean, we see clear reflexes, or rallies, resistance, support exactly at our key Fibonacci levels, give or take a little bit here or there. But, I mean, very, very clearly acting off the fibs. So, if we get back above the 382, that looks okay. We reclaim support, and then maybe off to the 0.5, 618, 786, again, could get super, super juicy if that happens. We could be looking at potentially, 111% upside. Obviously, we would put a couple of trade setups in play. Damn it. We put a couple of trade setups in play. Obviously, if you take out the lows, we want to get out of this. We're looking for essentially minimum the 0.5 will be 24%. The stop is too much for that. So you would have to basically reclaim the 382, hold support above our resistance and our previous support, and now they're both acting as support, and then we can take our entry with a 5.5% stop loss, or at least maybe a 7, 8, with 25% upside. That would be our initial target, and then obviously we have a series of other targets. That would be 5% upside, or 5 to 1 risk reward ratio, 10 to 1 risk reward ratio, and then obviously the 786 is our real target for another lower high. 111% upside, 5.5% stop loss. That's what I got. You could run that big stop loss down here to like 25, 26 if you wanted to, and just go all or nothing on this. I'd step it up how we just discussed. 20 to 1 risk reward ratio. If we're right, we get $20 for each dollar we risk. If we're wrong, we lose $1. I don't know about you, but I like them odds. 111% upside, 5.5% stop loss. Bearish control zone, starting to find some kind of support, and we didn't take out the previous low right here. So what do we have? We have a low, we have a high, we have a higher low, we have a same high, and then if we put in another higher low right here, I mean, I would say that there's a very high likelihood we retest those highs and probably make it up here. So is this going to be an awesome, awesome potential in gold and silver miners? Yes. But is it time right now? No, we just need a little itty bit of momentum confirmation. But definitely some amazing opportunity on those. So I'm going to keep it pretty quick on the stuff that we look at every time and get to these member requests, obviously, because this is taking forever, as always. So ACB, 821 cross to the upside at resistance. If we break through the resistance, we likely get that push up to $2.28. So all we're looking for on this, and again, if we see this rally keep moving to the upside, pot stocks are going to rip and roar, in my opinion. Obviously not financial advice. And drugs are bad. But investing in drugs is technically good. Or okay. So, we can't use that swing as a low. It's too deep. So what we got to do is say, okay, if we cross the 821 back to the downside, we can start using that. But essentially what we're looking for is a 10% stop loss, upside of 40% to basically come back and backtest the macro fib. Slightly higher is the gap fill, but we just say 4 to 1 on this one. $2.33 target, $1.49 stop loss, entry level right friggin' now. Or if you're already in some of these positions because you've been sort of like swing/building positions like myself, not bad. Tilray. So Tilray usually does pretty well when pot stocks bust off. We're not crazy far below. I don't even know what's going on here. We're not crazy far below that 200 exponential and simple. So this is that same trade setup we've had here. Obviously, since we came up, we said if we took out that previous low, we wanted out. Came all the way down to it, found support, came back up, then kind of chopping around. Confirmed the 821 cross back here. And, we're looking for initially 33% upside with 16 stop loss. It's only 2 to 1 risk reward ratio. Not really a viable trade setup. But, just so happens it went in our favor. Really, this is the trade setup, though. It's that same reversion to the mean, retest of a 200 exponential and simple. Likely it gets front run, so we want to take profits in advance. We don't want to wait and get stuck in this trade as it starts rolling over. But 74% upside, 16% stop loss. I mean, at this point in time, we're a couple percent to the upside away from moving our stop loss up to break even. Arguably, though, I'm not really looking to get like stopped out of these positions. I'm more just like building slow positions off of like scalp trades. But depending on what you're doing, it could be a nice trade setup there as well. Most of the pot stocks look about the same. CCJ came up, filled the gap. Very nice. Obviously, this was one that I did take a decent position in from the lows right here. Obviously, we're looking for that 80% upside. Are we going to get it? I don't know. Are we up 40% already? We are. So CCJ, Cameco, still seeing that weakness. 200 simple above the 200 exponential. This thing is giving us a false rosy picture, in my opinion. URA giving us a little more accurate of what amounts to a bear market retest before we likely roll over. We are seeing something very important right here too. We have a high, we have a higher high. Price action, we have a high, we have a lower high. We're seeing some bearish divergence between both of our indicator oscillators in relation to price action. Likely leads to new lows, which is actually what we're looking for a buying opportunity, somewhere around the high 14s, low 15s. Again, we've done some deep analysis on all these, so I'm just kind of ripping through them. GSG, commodity index. So it came back down, back tested the lows, same low again. Kind of gapped down, but did the same thing both times. So is this a double bottom? It looks like it to me. Are we getting bullish divergence? Here we have a low. Here we potentially rolling over. Could be some bullish divergence developing. Here we see a low again. Here we see a much higher low. 2 green histograms in a row. So again, bullish divergence already developed. So where does that take us? Well, we made it to the 382. We fell short at the 0.5. So that's probably our next target. But realistically, could see the 618. I mean, look, I'm going to tell you the truth right now, okay? We've been crushing it on these trades lately. Just absolutely dominating the market. Trade setups have been absolutely phenomenal. Completely dominant. That being said, what often happens with markets is you win a bunch in a row and then you lose a bunch in a row. So it's important to realize when you're losing or when something is changing. So we've had a ton of wins in a row already. So we're going further and further out the risk curve because the best stuff, the moves have already happened on. The shitty stuff is like last for it to happen on. And then it just kind of pops off in the middle. But like we always say, it's like waiting on that popcorn to pop. You could stare at one specific kernel and maybe that one pops. But if it's out of 100, what's the chances that one pops off? Versus if you just say, okay, I'll just bet on 10 kernels. And then like some of them are going to pop. And if we take nice risk reward trade setups and nice, probability of success and correct position sizing and everything, we're going to win. Even if our couple of them don't pop on the ones that do. So that being said, the longer this rally goes for and the more trade setups play out and the more we're winning and the more we get confident and the more we go further out in the risk curve, the more we need to actually expect that probably we're going to be losing soon. So it's not crazy to think the same way we had like 20 trade setups over like the last month. And like, I think like 17 of them have like played out 75% or more to the upside, like of the trade setup, not like 75% gains, but 75% of the trade setup or more has already completed to the upside. And we've had like 2 that have done nothing. And I think like the Tesla one was the one that we took a small win on, but basically just got stopped out because we're a moron and then it went in our trade favor. So we're not going to win another 20 in a row. Or if we do win another 20 in a row, we're not going to win another 10 after that or another 20 after that. So we're going to start failing. These trade setups are going to start blowing up. So it's very, 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 very important that we maintain discipline with our position sizing and we maintain discipline taking profits and we stick to the basics. So that being said, we have a potential 6.5% upside target to the 0.5, which is the minimum. We almost got there already once. So realistically, I would say it's 9.4% upside to the 618 is our target with the stop loss below the low. So if we close a new low, essentially, taking out that previous low, at which point in time we might put in a triple bullish divergence, at which point in time that could be a buying opportunity. But we have to reevaluate. We have to stick to the stop. 4% stop loss, 9% reward, 2.2 to 1 risk reward on this trade setup. we are technically bullish. We're above the 200 exponential and simple. So this is the minimum we need to even take this trade setup. If there wasn't bullish divergence off this double bottom, off of the moving average, I wouldn't even worry about this, especially for like such a small percent. But I'm going to take a bite at this one just because we could be at new highs off these, and actually like 9% is a joke. And like in all actuality, like we're just headed back to highs, and then after that, like all-time highs. So, you know, is it 20%? Is it 30%? Is it 50%? Is it 9%? We'll have to wait and see. But, you know, this is essentially just buying the dip, buying into strength on the pullback. The opposite of what we're doing in all these bearish stocks. JJC, so copper, keeping it simple here. We're in a very strong bull market. And then obviously we see the 200 simple crossing over the top. We then put in a new high. So again, one of those topping or bottoming signals when 200 simple crosses above or below, respectively. Bear market confirmed. New lows, melt down to the 0.5 of the macro from the bottom of the Rona lows to the top right here. So we had a 50% retracement. We back tested to the 382. So now what's, you know, think back to that that ruddy chart, the Russell 2000. Choose your own adventure. I mean, this is it, right? So we're either going to bounce back up here to the 236, at which point in time that would be a back test of 200 exponential and simple, and we likely get rejected around $20.39, or we break back down to the fib, which we already went to once. So if we break down to that level, what's really going to happen? Well, probably we're actually just going to the next level. So now we have essentially the 618 for a lower low at 1481, or we have the 236 at 2039. Now if we come back up and put in a you know, new high right here, but what would that really be? Just a back test of the breakdown of the macro 236. So this thing either bottom or it's going way lower right away, or it's going to back test and then go lower after that. We don't know which one, but we have some very clear identified areas here. Copper is clearly in a bear market, but we haven't back tested the 200 exponential and simple. So right now, as long as we're above the 382, I think it's more likely than not we go to the 236. Again, we don't want to get like overly bullish on too many things at once. But if we're using proper position sizing and we just spread out smaller positions in more assets, you know, we're more likely to hit, you know, if we're taking good trade setups. 12.5% upside. We have to run like obviously a super tight stop loss on this because we don't want to lose the 382. We also don't want to lose the 821 across the upside. So if we run that 4.5%, if we lose the 821, if we lose the 382 fib, that gives us a target to the upside of the 236, the back test, like 12.5% upside, 4% downside. It's about a 3-to-1 risk-reward ratio. We are technically bearish right now, so it's a minimum we want. You know, not a great trade setup, but there's some potential there. Not great, but there's some potential. It's like the minimum we could like justify taking. So, okay. So, all right, we're about to get into all the requests. We have like 3 more, and then there's like 7 or 8 requests, all with like potential massive upside or sweet trade setups. So if you made it this far, trust me, it was worth it. But first, we got to look at random length lumber futures, LBS1, the old lobster, the wooden lobster. So yeah, let's just zoom way out here real quick and see what's going on since the last time we talked about lumber. On the monthly, we obviously have 200 exponential and simple, very strong uptrend, telling us lumber is likely to cost more going into the future. But right now, what's happening? We have a high, we have a low, we have a lower high, came back down. We essentially put in the same low, maybe slightly lower low. You know, looks like we have momentum to the downside. Back test, rejection off of this one here. Another back test of the 821 cross, rejection. And now off the lows, we're getting essentially a dead cat bounce. Does it take us back up to rejection again, or does it roll back over? Based on this chart, it probably rolls back over. I think we really want to get down here to like 435, possibly as low as 377. It sounds crazy right now, and we've gotten so close to it so many times, but I wouldn't rule it out. We've got a high, we've got a low, we've got a lower high. This could chop around a bit, come back up, but eventually put in a lower low, and that's what I think is likely to happen on this. Again, even though I'm very, very bullish on lumber to the upside, and we've had some nice, you know, setups play out and everything. This was obviously our target. We got there initially, got a nice bounce off it. This has been in there from like months and months and months ago, way before these candles. So when we came down to it and we hit our target right here, that got like a little dead cat bounce, and then it came back down, overshot it, another dead cat bounce. Looks like on the weekly, you know, we're losing the 200 exponential on simple. We got a back test here. We put in a lower high. Then we come back down, lose it. Then we back test it and then confirm it to a bear market and go lower. 200 simple is basically flat. 200 exponential is already negative. Hard buy coming out of the bearish control zone. There's an argument for some bullish momentum right here, but the slope just flipped blue and we're underneath it. A lot of times we get that rejection and it rolls over. So likely we get that lower low target. Now, what's worth paying attention to though is that we have sort of like this little wedge flag deal going on here with target to upside back all the way up to the top of the range. So could this go either way? 100%. I would say as long as we're in the range, that the target to the upside seems more likely, which is 69%. But if we come back down here and start closing outside of the support, we probably go much, much lower. To that target, basically. I say much, much lower, but it's like, I mean, is it really that much lower? I mean, it depends, because we kind of like melted down already, so it doesn't seem like a big deal. So the real question is, are we going to get something like this? Seems likely, because, you know, we trade the range, obviously, buy support, sell resistance. Or are we going to get something? We're going to get something more like this, where we just go A, B, and then actually we're just going to put in our C. Like, just, I mean, honestly, we got so close to it. It's like drawing it right here. It just seems like we're just like being stubborn, because it's like, oh, okay, yeah. So we got to 466, but our target was 420. Oh, fucking Elon. So are we like that stubborn? I mean, kind of. Maybe we'll just like be like, oh, well, we'll go to the 786. So how about 381? But anyway, that's basically what we're looking at on lumber. Worth paying attention to, as obviously, you know, everything that we're hearing on the inflation and all that stuff is like, oh, it's because the energy come down. It's because the commodities come down. That's all the reason that the inflation is coming down. And that's great. So, but a lot of these commodities actually look like they're bottoming and about to rip to the upside. So even if they rip to the upside and then put in lower highs again, and then all of a sudden we have like all this delayed, you know, housing rent data showing up. And then it's like, oh, so the commodities and the fuel made it look like inflation was going down as the inflation levels ramped up for housing. And then if all of a sudden the commodities and the fuel start going up again while the housing's going up, while everything else, I mean, what are we going to do? Well, we're just going to print a new inflation high. And is that my base case? It is. It is indeed. So UTS, the old UTZ, member trade setup presentation, one of those beautiful, beautiful trades we like, with the 200 exponential getting nasty forever. Here we see a bottoming signal. The 200 simple crosses below the 200 exponential. We then, shortly afterwards, put in a bottom, back test that bottom, and then it's off to the races, straight up parabolic. We got a trade setup on this one's almost played out, 20-something% to the upside. We have another target up here at 47% to the upside. But the truth is, I mean, we're going to hit this target now. We're there. So then when we back test, we want to see support at the 382. So the real question is, since this is obviously already in this trade setup and everything, the real question is, when we come back down, do we just reload at the 382? And then, you know, look for that same move up to the 618 and then up to the 786 and then up to the all-time high? Yeah, that's what we do. Because when we look at this on longer time frames, I mean, this looks juicy. You know, very clear bear trend, back on top of the 821, ready to have the bull cross if we hold, ready to have the, you know, stochastics leave the bearish control zone and cross. We see the knife has crossed back above the purple and blue stochastics. We see two green histograms. We see some pretty juicy green candles. I mean, this candle right here literally went 1, 2, 3, 4, 5, 6, 7, 8. So you're like, oh, okay. The last 9 months of downtrend, you're my bitch in one candle. Kind of a big deal. Kind of a big deal. You could call that a 9-line strike. Patented. Ha. Ha. That's stupid. UTZ on the weekly, the 821 have crossed back to the upside. Again, we have like clearly like low consolidation through here, and then we have a higher low. So looks like we are in for a nice little move to the upside, gaining momentum, blue slope, all green histograms above the 0 line, stochastics powerfully angled to the upside inside of the bullish control zone. Do we top out right here or very close to it? Short term, we probably do. But then again, do we reload on that back test? We probably do. And props to my homie for throwing that one out there. So Ford, we talked about this one last one, hit the essentially the target to the upside. It's still kind of creeping up here a little bit, but I'm not greedy. I don't care about this last couple percent. The back test of the 200 exponential and simple. This is just bull trend, bear trend, back test, go lower. So we'll probably get our lower downside targets in the near future, like 950. I'm not going to ride this thing down from 16 to 950. We got out at like 20. It shot to the upside afterwards. Felt pretty stupid for about a week, and then meltdown. So sometimes you got to just stick to your guns on stuff. One important thing about this too that we discussed was when we broke down here again, 200 simple crossed above the 200 exponential. Very clear sign that we're losing momentum and topping out. We actually got a little warning right here, crossed the exponential back, went to new highs, and then it played out. So again, hard sell signal, getting tired, time to lay its head down. All right, on to the good stuff. Let's take a 1 minute break. We're at 2 hours and 51 minutes. So this stream is going to go over 3 for sure. Probably like 3.5. So let's take a 2-minute break. I'm just going to use the restroom, grab a drink real quick, and then we'll rip into all these awesome member requests. All right, let's do it. I think that stupid camera is about done. Its life cycle has completed, or close to it. Okay, so let's go ahead and keep on ripping. So if you are just tuning in, remember this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. Please keep in mind that the assets we're about to take a look at were member requests. I cannot vouch for the quality of these assets, nor can I vouch for like anything to do with them. You know, essentially we're just doing some technical analysis. But some of them are juicy. So we have SWN first, Southwestern Energy Company. So just looking at this on the monthly. So what do we see here on the monthly? Okay, we've got data going back to the 1970s. That's always good. We see consistent, you know, lows, highs, higher lows, higher highs, higher lows again. Headed back to higher highs, possibly. Very clearly in a monthly bear market. Oftentimes what we see is when we get the confirmation of the bear market based on 200 exponential and simple, that's actually the bottom, which obviously is what happened here. Again, we see the 200 simple is above the 200 exponential, telling us there's a very high likelihood that the momentum is running out to the downside. Here, when they cross to the upside, when the 200 simple crosses above, after that happens, we actually see much lower lows. So again, we don't want to get excited that that's the bottom or that it's the top. We just know that the momentum is running out for whatever's taking place. So the 200 exponential is accelerating, you know, down here, obviously, and now we're on our way to back test it. On the monthly chart, it looks okay long term, you know, obviously, because we're putting in higher lows and higher highs consistently. But what we have to worry about is, you know, obviously, we're well off of the lows. So if this thing gets a pullback, it could get nasty. So on the monthly chart, it doesn't look like an ideal opportunity to enter because the majority of the move has already played out and we're very close to what we know is going to be resistance. Now, do we break through that resistance? Well, then we got another resistance. So we have to wait and see. We're at $7 though. That's $14. That's $21. So we're not going to be able to run a stop loss for a new low, but we can run it off like one of these swings right here or a breakdown from the 821, etc. But in all actuality, we're actually going to go down to some shorter time frames and see what those look like. Because maybe we can get a better idea for like a good trade setup or what's likely to happen with this going into the future. Now, obviously, in hindsight, you know, it's very easy to look at this and say, oh, well, really, when was the chance to enter? But it's okay because when we do this enough times, we keep doing it, we keep doing it, we keep doing it. And you're like, oh, actually, like, look how many times this setup plays out. And like then when we see that setup, we can trade it with like extreme confidence. So here we have a top and then we back test it, resistance, back test it, resistance, resistance, the whole time making new all-time lows or new cycle lows. And then eventually we get this big juicy boy right here, takes us above resistance. We back test, back test, back test, back test. And what happens this whole time? You're so tall and you're so handsome and your muscles are big and, you know, all just that reassurance. The market's like, yeah, you know what? I am strong. I am attractive. Yeah, let's fucking do this. Yeah, let's go. And then next thing you know, 821 crossing to the upside and boom, off to the races. So obviously that would have been the ideal time to buy was on the back test after the breakout. Now it's too late for that. So maybe we buy the 821 cross after that happens. Well, too late for that. Okay. So I guess that's it then. Well, you guessed wrong. We'll find something. All right, so from the top to the bottom right here, see some pretty clear resistance. Not so much like, I mean, there's definitely some interaction at the 236, but looking back, we can see some clear interaction at the 382. Prices like drawn to those levels. We don't necessarily like top and bottom exactly at those levels, but we like overshoot them a lot or undershoot them and then just kind of consolidate before the breakdown. We see like a little stall, a breakdown, same thing. So it's kind of interacting with the fibs, but it's not beautiful. So we could assume if we hit the 0.5, we overshoot it, we come back down, we consolidate. Well, here we overshoot the 382, we come back down, we consolidate. We overshoot the 0.5, we come back down, we consolidate. Well, what's our target? It's obviously the 618. Well, where's the 200 exponential at? Well, right above it. So what's probably going to happen? Probably just going to overshoot the 618 and then hit that $13 target and then come back down and consolidate. If I had to guess. If I had to guess. So we're looking for something like this as far as support. So can we use this ascending support for some sort of, support basically for like a stop loss to a continuation trade. Is it worth it? Is there a stop loss that we can put in tight enough? Let's actually go down to the weekly now and see if anything presents itself. But I do already see a nice setup. Oh yeah, and look at that. The nice setup just went from nice to very nice. So, all right. So obviously resistance, the breakout, the back test, the continuation, the above the 200 simple back test. We basically are range bound. I say it all the time. As long as we're between the 200 simple and the 200 exponential, we're range bound. And you're like, well, that doesn't help. Well, it does when we break out. And here we break out to the upside. So we buy support, we sell resistance. Is there enough of a range that you could have been scalping this like the whole time? 43%. So yeah, I'd say you could probably scalp that pretty juicily. But the worst case scenario is I'm up 43%. I'm break even. I'm up 43%. I'm break even. I'm up 43%. This time I'm selling because I don't trust it. Oh no. So that's how it usually happens. You're like, oh fuck, the one time. So anyway, what we're paying attention to is obviously this ascending support line here. It's not as clean cut on this time frame, so we're actually going to like slide it down here just a little bit, and that's going to give us a little more clearly what we want here. So now that we have captured the 200 exponential, the last thing we want to do is come back down to 200 simple. Now that we have tagged the 0.5, the last thing we want to do is lose the 382. So is there a way that we can present that in a trade setup that would be functional? Well, we got to see, like, is this going to, like, we kind of had the 821 cross. It looks like it wanted to go lower, but we found support. So we're just going to go higher from here? Probably, honestly. The way this looks, it looks likely that it wants to see continuation to the upside. So let's just say right now, we're just going to say, like, F it. I just got to get in this thing. I can't risk it running away from me. So what kind of stop loss do we need to have if we're counting, like, losing the 200 exponential or closing below the 200 exponential, I should say, losing that previous low right here, that little swing from like 4 days ago? It's an 18% stop loss. Not ideal. Not ideal. But when we look at our 618 target, 70% upside. So it's 3.86 to 1. And we're looking at this on the weekly. So you're like, well, so is it a bull trend on the weekly? Is that okay? And we just say, well, like, it's bullish on the weekly, so we can take a 2 to 1 risk reward ratio. Or you're like, oh, but it's bearish on the daily or the monthly, so it needs to be 3 to 1. Look, you got to make up those decisions on your own. Obviously, the longer the time frame, the higher the precedence. But I would say a weekly is a pretty good place to start. And obviously, what we talk about all the time is this transition. The transition from a bear market into a bull market. And that's where the big, juicy trades come from. Because the last time this happened, and by no means is this any indication of what's going to happen in the future, but let's just say you were just using my strategy like back in 2000, let's say, roughly. And you're like, well, of course, if you buy it in 2000 and then 20 years go by, it's going to do good. Of course. But is it going to do 4,389 motherfucking percent good? Well, I mean, probably outperform the S&P. I don't know. Maybe a little bit. So is that going to happen again? Are we getting ready for a 4,300 whatever percent to the upside? So who cares about 18% stop loss? Yeah, probably. Maybe not. Maybe it only goes up 2,000. Maybe it goes up 500. Maybe it goes up 100 times. I mean, or 100%. I mean, 1,000. Who knows? Is 10x okay? I mean, it's not great. Oh, no, wait. Actually, that's awesome. So again, a really nice looking chart here on the weekly. And then realistically, I mean, this is like the, let me just get my foot in the door trade setup. And then realistically, what you're looking for is a back test of 786, which is 223% to the upside. And then you know what? I mean, honestly, if we get to the 786, I mean, we might as well just go to the previous high. And if we make it to the previous high, I mean, come on, let's be real. We're probably going to at least the 1.236 fib extension. And if we make it to 1.236 fib extension, I mean, I don't want to get greedy, but I mean, the truth is, we're going to make it to 1.618. Probably. Very high probability. So 651%, 1,815%, or the unimaginable, 8,134%. And you're like, it'll never go up 8,134%. You're stupid. Well, maybe not. But maybe it does. So, again, absolutely beautiful chart request by one of the group members. Congratulations. I love that you guys are like, you have in like the last month, you guys have went from submitting the trashiest, worst garbage assets that look like they're going to zero to like presenting absolutely beautiful, amazing charts for like sick trade setups. So keep it up, guys. You are fucking crushing it. Love it. Love it, guys. So that being said, SWN on the daily, not going to look much different than it is on the weekly. What we do see playing out here, which obviously in hindsight, again, hindsight TA is super, super easy. Everybody does it. It's the real technical analysts like us here that do things in advance. So, you know, we're looking back at this one, obviously, but we saw the 200 exponential and simple crossing up on the daily here. It failed. Here, it failed. So should we be really, really careful that that's not what we're seeing in markets right now? Yes, we really should, because it could definitely, definitely fail. Like all of the massive moves that we've had up into resistance, likely we see distribution and then new lows. Now, what do we see here? The 821 across the upside, that was that big burst, and that was actually the confirmed breakout. So realistically, what happened here? We have a low. We don't know for sure if it's a low until we hit the 236 from the high to the low. That's how we confirm Fibonacci's valid. So here we burst up, we hit the 236, confirming that the low is in, probably, most definitely, at least tradably for now. And that just so happens to line up with the resistance, which just so happens to line up with the, 200 exponential and simple bull cross, which just so happens to line up with like, some pretty sick, nasty continuation. 179%. Almost 300% up at the peak right there. So again, I mean, we missed a nice trade, but it doesn't mean there's not still some amazing potential out there. So, held up pretty good on an earnings miss as well. So, so again, we don't want to get too excited for these. At any point in time, these could just start rolling over and just completely crashing. And it's super, super important that we use proper position sizing, risk management, and focus on probability of success. Give ourselves an edge over the market. All right, next we have KEI, which is Colibri Global Energy. All right, so if we go over to the monthly, all right, so a little different of a picture here. 2009, we got history back to like 2000 and whatever, but we have a low back here at 2008 or 9. We have a high afterwards. So we have a high, then a low, then a higher high, then a higher low, but then we put in a lower high right here, and then we put in a lower low. So we go from essentially, what is a uptrend based on a high, a higher high, a low, a lower high, to essentially now a downtrend. So once we confirm it's a downtrend, what are we going to do? We're going to look for essentially like trend line resistance, something along these lines. So obviously at the time when we're first drawing this, we only have these 2 points here and then the bottom point. So if we go from this point to this point, and then obviously draw this down to the bottom here, we look at this now into the future, and how did it do? Well, pretty good. It had a little false breakout right here, or failed breakout, and then it rolled over. Is there a way we could draw this better now in hindsight? I think we could. I think we could ninja it up just a little bit. Get our ninja on. All right, so that looks pretty good. So we got a high, a high, a high. We have 3 touches right here. We got a low wick. We got a low breakdown, and then low right here. So 3 touches on the bottom, 3 touches on top. Heart line, clear interactions. Here we see it's support, it's resistance. Resistance here, we break through it. We go back to the top of the channel. Support, back test, resistance, resistance. Break through it to the top of the channel. Support, fails, resistance, 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 support, support, support. Bust a nut. Come up here, basically confirm a breakout. So what just happened on the monthly chart on this asset? Well, we were in a really long downtrend, getting our dick kicked in. I mean, not us, but somebody was. From 2011, so like 11-year downtrend. That's not bad. I wonder what happens after you break out of that. Probably a decent move. A decent move to all-time highs. Well, we don't know about that, but we could say probably a measured move. Measure move of the channel from the breakout or from the back test, depending on how you want to do it, gives us a rough target of $20.35. We're at $2 now. So let me just do some quick calculations. 10x. Oh, that's not bad. Huh. That's weird. 10x. It's crazy. So what do we need to do here? So if we fib from the top to the bottom, look for some confluence and some fib levels. So again, clear resistance and support at the 236, clear support and resistance at the 382. Pretty clear here. A little bit through here. A little bit through here. 618, pretty clear. And then 786, pretty clear. And then the 886 is just whatever. So if we made it to the 382 from the bottom, the first one was the 236. The next one was the 382. The next one's the 0.5. The next one's the 618. The next one's the 786. So do we see any confluence between our breakout of the channel, measure move, and our Fibonacci? Well, I would say, yeah, definitely. Definitely. So where do we expect to get to? We expect to get to the 0.5. 50% of the move down to the upside. If it's bullish, we expect to get to the 618. If it's really bullish, to 786. And if we break through 786, probably new all-time highs. So we had this on the monthly, building up some momentum to the upside. Losing the slope line right here, but we're above it. So it's probably going to just flip back blue here any second. We're above the zero line, bunch of green histograms in a row, about to flip the slope blue, bullish momentum. 821 across the upside, breakdown from a downtrend, breakout, bullish. The knife is pretty aggressive right here. Does that have to be a top? No, I don't think so. I think that this is literally just basically like the market just piling in all at once and a bunch of momentum coming in. Obviously a volume spike, back to the top of the range and a confirmed breakout. So likely, I think actually we probably push up here again. Eventually we see a monthly lower high on the knife with some bearish divergence, and then we get like a decent pullback. But before that happens, we probably go much higher. So let's look at this on shorter time frames and see if this looks super juicy. All right, so we have a descending channel right here, obviously. We have a 200 exponentials and simple and the breakout. And what does it look like we're doing? Now, we had a false breakout right here, or failed breakout. We had a failed breakout right here, or arguably you could just call them, what it is, a backtest, a reversion to the mean, rejection, backtest, reversion to the mean, rejection, backtest, reversion to the mean, rejection, maybe. Or maybe now this one's going to confirm. So we are above the 200 exponential and simple, 200 exponential is blue, 200 simple is below it now. So what does that mean? Well, we know when the 200 exponential cross above the 200 simple, that means the momentum is waning. So here it happens, and then we go to a new low. And then actually 200 exponential crosses back down again. So it's like, oh, false alarm. And then here, 200 exponential crosses back above, or 200 simple crosses down below. So is it a false alarm again? Or is this really just like confirmation, like, hey, it's about to get juicy? We see the blue stochastic putting in a series of lows right around the same level. Each of those lows is higher. Actually, we have a little bullish divergence here because this one actually is lower. And then we came back down to it again, much higher on price action right here. But, that same low level right here. So it's not quite another driver bullish divergence. But if it comes down even a little bit more, if there's just a little hiccup and it comes down, we're going to get another driver bullish divergence, which could look nice. Obviously, we have the stochastics kind of rolling over. We have lost the blue slope line. So we know what happens here typically. We come up back test, we get rejected. And that's like a, pretty clear, like strong rejection. But what does that likely do? It likely takes us down to that 200 simple again. Or at least some kind of like fight takes place around this level. So is right now the absolute best time to get into this? Maybe not. But is there a good enough trade setup? Or is there some potential here? I really think there is. I honestly do. So let's go back to the weekly here. Obviously, we see the daily is nice and bullish. So looks good. Looks good. So let's figure out a trade setup so we can capture this 10x move. All right. So obviously, we're on log scale. So as we move it to the bottom, it just gets like insane. All right. So we're above the 382 now. So we definitely don't want to lose the 382. We know that. We're above the 200 exponential and the 200 simple now. Also, the swing low corresponds with them. So we definitely don't want to lose those levels. So if we go by 200 simple, that's like a 32% stop loss. It's probably what we should use, honestly. If we go from closes, it's a 21% stop loss. Now, you're like 30%. You're going to risk 30%. Well, you just have to figure out the trade differently. So normally what we would do is say like, okay, you have $100, you're going to split it into 10 lots, and then you're going to put one lot in each of 10 different trade setups. And then, blah, blah, blah. When it's all said and done, you should have won more than you lost. You should have gained more on the ones you won than you lost on the ones you lost. Therefore, you should end up like net positive, assuming you're trading with the trend, all that good stuff we always do and we talk about over and over again. So in this case, you're like, well, I don't want to risk 30% of 10% of my account. So 3% of my whole account on this trade setup. And that is completely fine. And matter of fact, that's a responsible thing to do for sure. So what you do is you just figure out what you're willing to risk. So you say, okay, if I'm willing to risk, let's say, I don't want to risk 3% of that $10, which is 3% of my total account. Or 30% of that $10, which is 3% of my whole account. So maybe I want to risk 1% of my whole account. So instead of trading a full lot size, 1/10 of my account, I'm going to trade a third lot size, which is like 1/30th of my account. So instead of trading a $10 position with a $3 stop loss that I would lose with a potential of, a 10x, I'm going to actually just trade a $3 position with a $1 stop loss, again, 33%. And then if we win on that position, we're going to go from 3 to 30. So that way you're essentially scaling your position based on your stop loss. Normally we want to scale our stop loss based on like the position, but it's okay to do this as long as you know what you're doing and you're doing it like responsibly. So that being said, we could take a third lot size here, still run the stop loss, and realistically, what does it come down to? Well, we know right away. If it starts moving in our favor, the first thing we want to do is like tighten the stop loss up or put it at break even. Now, we don't want to get too reckless with it, but realistically, what are we looking at right here? Even with a 32%, wait, did I say 10 to 1 earlier? What did I go? I think I just slapped this up here. Didn't I say 10 to 1? Oh, you know what? It was, I think with that. I don't know. Maybe didn't I say from 2 to 20? Oh, my bad. 10x. And yeah, the risk reward ratio. My bad. I confused myself there. Okay, so from where we're at right now, the measure move and the 786 is 840%, and the stop loss would be 32%. So it's a 25.5 to 1 risk reward ratio. So I bet $1, or in this case, $3. And if I'm right, I get 75. If I'm wrong, I lose 3. So you're like, well, that's just crazy. You'd be fucking crazy not to take that trade. Exactly. Which is why I'm going to take it. And I'm not going to tell anyone else about it. And there's no way that anyone else will ever be able to take this trade setup. Because obviously, this is my trade setup. And I would feel personally violated. Even though someone else actually sent me this chart and, asked about it. I would feel personally violated if somebody was to like hijack my trade setup and use it to make a bunch of money. Because obviously, none of this is financial advice. Not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. All right, so, realistically though, what are we looking at? That's our entry level trade, 3 to 1 risk reward ratio. Up to that initial target would be the 0.5. Stop loss as discussed. Run the 30, or maybe on the beginning, run the 20 and re-enter if you get stopped out. At a better price. There's definitely options for potential here, but I'm not going to get crazy. I'm not going to hold your hand. I will if you ask nicely, but I'm not going to do it without you asking. All right, so if we get to the 618, 282%, 33%, that is a 8.47 to 1 risk reward ratio, thick and juicy. And then, of course, the 857, 25 to 1 risk reward ratio. If we break through the 786, let's be real, we reload at the 618. Once we top out, come back down, maybe all-time highs. If not, who gives a damn? Once again, fucking beautiful chart. Beautiful chart. Definitely some nice potential for a trade setup right here. Now, short term, this looks good as long as we're above that slope line, as long as we don't take out that low. But for real, no joke, if we do break back down and this fails, we need to get the hell out. We cannot just sit in this and hope it goes our way. Because if it decides to fail and revisit even if it revisits the 236, that's 56%. And if it goes back down to the lows, it's 88.5%. So under no circumstances do we enter a position on something like this without, you don't even have to put a hard stop in the books if you don't want to. But you have to, absolutely have to have a line in the sand, stop loss, where you say, you know what? If we close below this, I'm closing my position, regardless of what I think could happen. And even if the next day it just shoots back up or whatever, by all means, you can re-enter if something changes, but you do not eat 88% losses to the face under zero circumstances. All right, so that is Colibri Global Energy. Again, gotta love the group members just presenting so many awesome assets. Touche, my friends. Touche. All right, so got a few left, like 6 more to go. All good ones, I'm assuming. Like 4 of them I haven't looked at, including the 2 we just looked at. So, WHC, Whitehaven Coal Limited. So on the daily, looks good. I mean, basically a blue sky breakout, at least for this cycle. Let's look at the real chart, though. Okay, so we got to be careful right here. So we took out the previous high, which was 2018, but we still have this little cluster from 2011. Obviously, we know that's where energy peaked out at. So definitely important to get past that. We do have a series of higher lows. We do have a series of higher highs. That is definitely good. We have not taken out the all-time high, but we're very close to it. Seems likely at this point in time with momentum in our favor. Bunch of green histograms, blue slope line, Stokes accelerating to the upside, bullish control zone. Everything looks good here. But again, got to be real careful of a double top. And the truth is with this, after the massive run it already had, the way to play this is we break out, we backtest, it holds, and we buy momentum. I'm not going to buy into resistance right now. It's just not a good idea at all. But that being said, we're seeing the weekly 200 exponential crossing above the 200 simple. That is great. Obviously, we saw, essentially the backtest come up here. So it's not crazy to think we get a backtest at some point in time. Could very well see this print bearish divergence in the very near future. This looks the Stokes look very likely to print bearish divergence, come back up here, roll over. Bearish divergence on the knife already. Looks like it's probably about to get rejected right here and come back down. And then there will be more opportunity. Yeah, I don't know. We really got to see what happens. If it holds that previous high at like 586, it's probably okay as long as it like cools down and builds some momentum. Right now, it looks like it's about to get rejected, though. Under no circumstances would I enter this between the price that we're at now, which is 643 and 727. I would just wait for a new all-time high or a pullback. Yeah, but this one, there's just nothing really here right now. It's either got to be a blue sky breakout or you got to buy at some kind of value. But the risk reward right now is like disgusting. The amount of risk you take buying into this right now. Let's do this a different way. Let's look at this as a parabola. So what we're going to do is connect the first 2 lows right here. And then we're going to connect the next lows right here. So it looks like that's our parabola. We started accelerating, putting a high. The acceleration continued and actually sped up. Here we didn't get back down to the slope line. So it's a little early to tell, but we could arguably look for some kind of potential for like another level of acceleration. Has just taken place. So what we're looking for is basically the parabola to start to roll over. So here we have white. It's like a decent little uptrend. Here it's accelerating to the upside. Here it's getting like super acceleration. Yeah, really got to I would look for a backtest of green and then look for that, honestly. But not really much here on this one. Are we still, you guys still got me there? We coming through loud and clear? It's, YouTube's telling me that they're having some technical difficulties. If somebody could just let me know. We're getting an error. Yeah, I don't know. I think we might have lost it. If somebody's still there, let me know. You can hear me coming through there. It looks like we might be dropping the stream. Yeah. All right. So I will. I'm gonna keep going for a second and see if somebody chimes in to let me know. But that might be a wrap. Chances are, actually, you guys probably can't hear me anymore. So, but we will pick up with these on the next stream if I don't hear back from somebody. Oh, you got me right now, Jayhoff? Can you see everything coming through? It's still giving me an error saying it's not working. Sorry for yelling. That's fucking awesome. Okay, so we'll keep going for a second there and see if this gets back going. I don't know what's going on. Are you guys getting a clear picture and you can hear me and everything? It might be because we went so long. I think like YouTube acts a fool after like 3 hours sometimes. Yeah, I don't know. We'll keep going until I hear otherwise. So, okay, sweet. You can. All right, great. Thank you, bud. Okay, so yeah, YouTube is just acting a fool, but it says excellent connection now. So, all right, so we have Huntsman Corporation. Again, we see the 200 simple rolling over, confirming into a bear market, consolidating at the lows. Obviously, this looks like our weaker sectors, like communication. So not ideal, obviously, as all I do is talk trash about them. If we go out to the monthly here, we see a low back in 2009. We have data going back to 2005. We see like 3 tops around that level, and we have broken through those tops, and we're backtesting what was resistance as support. We have a previous high right here that we have retraced inside of. Looks like we are at least temporarily finding some support at these levels. We're going to want to look at something along the lines of, that's weird. See, all right, so what I'm looking at is, obviously in real time, you would draw this as support. And then what it looks like happened beautifully, total dick move. Comes back down to support, rips to new highs, comes back down to support, loses support, people get scared, and then what is it? I mean, it's just a spring before we go higher. So it looks pretty nice. And then obviously we can see we just came back down to that level. So it looks like this is the outlier. And actually, like, if we draw it this way, it's like pretty much useless. Because we would have to be using the wicks down here if we want to use the wicks right there. And then realistically, what does that tell us? Pretty much the same thing. So it's pretty much the same either way if we're going by wicks or closes. I think I prefer the closes just slightly. But again, we can always look at it on a shorter time frame if we're not sure. But we are holding that ascending support line. And then if we just do something kind of like similar on the top, can't quite do it from there. Let's try doing it from here. Oh, yeah. Got a real nice resistance. We're getting a wedgie. We've got a wedgie. So yeah, we have an ascending wedge with that little false breakdown or failed breakdown. Looks pretty technically sound right here at support. Just basically got to resistance. So are we like in a tradable range right here? Yeah, I would say probably expect new highs. Expect this to hold until it doesn't. Like 55% potential upside. We see the 200 exponential and simple on the monthly have populated slightly below us. We don't want to come down and tag those, but if we do, we want it to look like this. We don't want to see consolidated like closes outside that range. We have a sell by sell. They're spaced out pretty evenly, which is obviously our divergence signal. So is this a macro topping signal or did it already play out? I would say it could go either way, but it probably already played out, at least like short term. Looking at the weekly, confirming back into a bull market. We had a little chop along the way throughout this ascending broadening wedge. Here we went bullish, here we went bearish, here we went bullish, here we went bearish. Bullish again, especially with the 200 exponential crossing up. If we come down here and lose the 200 simple, that's not going to look good. We don't want to do that. That would also line up with us losing the ascending support. So basically, if we were just going to range trade this, which is what we would do right now, and it's overall a pretty bullish chart. I mean, it just put in all-time highs, and arguably it's consolidating like at key support. Now, would it have been better if it didn't lose 34.75? Sure, of course. It would be better if it just went straight up tomorrow. But, we don't trade the charts we want. We trade the charts we have. That's fucking poetic. All right, so 13% downside. What are we looking for? Well, matter of fact, if we close below this swing low right here, and we lose the 200 exponential and simple, and we start closing longer time frames below the ascending support, we don't want to be in the trade anymore. So we have 16% downside for the stop loss at 24.62, and for upside, top of the channel, new all-time highs, we have 52%. That gives us a 3.29 to 1 risk-reward ratio. Again, if you don't want to do 15% stop loss, you do 7 into a half lot, blah, 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 blah. You guys know how it works. Pretty sure you can extrapolate situations pretty well. So if I give you one example, feel free to apply it to others. If you're not sure, just ask. So Huntsman Corporation on the weekly, definitely a nice little trade setup there. Looks good right now as long as we're above the 200 exponential and simple and they're blue. This looks like, basically just a range trade, which is always good. Buy support, sell resistance until something changes. On the daily, looks okay. We have red slope line. Histogram is substantially above it. Obviously not sustainable. We could come back down and get a little retest. Stochs look like they're coming back down. Pretty aggressive knife. But it does look like it's going to come back down here and test at least one more time. So the real question is, on the daily, is this getting ready to go lower? Or is it bottoming? I mean, this little consolidation looks like trash. So it wouldn't be crazy to think it comes down here to 27. So what I might do right here is do one initial entry right here. And then look to add if we can get a lower. If we come down lower. But under no circumstances do I want to be in this trade if we come down here. So even with the same upside target and we just get a better entry, which could or couldn't happen, and we might completely miss a trade right here, but at least we're in with half the lot here. But we might come down lower and we got a bad entry, but then we get a better entry. And then when it does go in our favor, if it does go in our favor, obviously the upside is even better. So it's 52% here. If we get the further downside to the alternative entry, it gives us 69%. 69. 7.7 risk-reward ratio with a 9% stop loss. So again, another nice one. You guys are fucking killing it today. Killing it with these requests. Good stuff. I mean, they can't all be winners, but I mean, 3 out of 4 ain't bad. All right, so STEM, Neuronetics. No, this is not betting on a STEMI check, okay? This is a stock. It has nothing to do with STEMI checks. All right? It's not AMC. So STEM on the monthly. Okay, so we have a all-time high 2017. We have a all-time low in 2020. We have a lower high in 2021. We have a higher low in 2022. So what do we actually have? We have basically a pretty neutral looking chart. Pretty friggin' neutral. Not a lot of usefulness. Maybe we should be going by the wicks. I don't know. That's okay. All right, so we basically just have a just neutral pattern. Obviously, this thing has wrecked from initial. I mean, let's be real. So you're like June 2018. You're like, this is a good investment. It looks pretty good. I think I'm gonna give it a shot at $24, and then it goes all the way down to like $1, and then you're like, oh, finally, it's coming back. I just can't wait to get back, break even. Puts in another lower high, and then you're like, oh shit, not good. And then you're like, well, at least put in a higher low. It only went to $3 this time, so that's not bad. Where does it likely go next? I mean, probably 1093. Let's throw in a fib from the top to the bottom, and I bet we're going to see some confluence. Oh, and we do. So we see key levels on the way down, resistance, support, capitulation, resistance, support, lows, resistance, support like a motherfucker, resistance, support. I mean, not very good support, but and then just a slight overshoot here. Probably flushed quite a few people out. So at this point in time, what seems likely? I mean, it seems like we're going to the 618. We have the all-time high. We have the 786. So likely we see the 618 next. And then realistically, if we want to get like super specific on long or on shorter time frames, we could do a fib from that other lower high as well, you know, and see for some confluence. So the 618 in orange is just above the 618 in yellow. And then, I mean, it lines up so close that basically all we want to do is when we get up to those take profit targets, we just don't want to get greedy, and we want to use both 618s to give us a red box area like that. So what is our upside potential from where we're at right now? Trade the range, 133%. What is our downside potential? We have to use the swing low on this time frame. There's nothing really else. 44%. I mean, again, it's doable. It would be right around 3-1, but it's definitely not ideal to be having a bunch of trades with like 30% stop losses, or any for that matter. Yeah, it's like 3-1 risk reward ratio, so not great, at least on this time frame. So let's see if we can find something better on a shorter, more realistic time frame. On the monthly, it does look like it's carving out a bottom too. Okay, so on the weekly, obviously in a bear market, big volume come in right here, and that was on the back test. So that means there's a bunch of people selling and then a bunch of people buying to get a big volume spike like that. The last time we saw a volume spike like that was at the bottom, right before we crossed 821 back to the upside. So basically exactly what we did right here. So it does seem like we are getting ready to backtest the 200 exponential and simple on the weekly, which would be right around like 8 to 950. So let's see how that lines up with our trade setup. Oh, look. Oh, look. Huh. That's weird. Confluence. So 200 exponential and simple lines up with our red box area. So probability says there's a like 90% chance that we get our nut. But still, not a great trade setup just because that massive 44% stop loss. So how do we do this without that crazy stop loss, but also still like a respectable trade setup? Well, we use like this little swing right here where we found support at the 236 and then also the 821. So if we cross 821 back bearish on the weekly, or we lose the 236, we need to take our stop and just get out. That will give us a 23% stop loss at $3.38. It gives us an entry where we're at right now, $4.40. I'm assuming we can't get a better entry, which again, I think we do. I think we buy the 236 and probably get a better entry. But that gives us 137% upside with a target of $10.50, 5.85 to 1 risk reward ratio. But let's look for, on the weekly here, we see all green histograms above the slope line flip blue above the 0 line. Beautiful momentum as the 821 are crossing. Very, very nice. Hard buy signal leaving the bearish control zone all the way up inside the bullish control zone. Are we topping now? Maybe we still got legs, but we don't want to get greedy with it and let it run away from us. But we also don't want to go too hard in the taint right now, and then it just comes back to bite us because it basically just is selling off. So we'll look at the daily and see again in a second here. But essentially, if we just take a like half lot or quarter lot or whatever we're doing right here, but half of the position that we want total at this level, and then we take the other half at the 236, and maybe even instead of using this as a stop loss, like a hard stop loss, we actually use like the average, like the essentially like dollar cost average on the pullback. What does that get us? And is it still good? So that now at that point in time, from the second entry up to the like 618, 200s, all the resistance, the clusterfuck of resistance, that would give us 32% downside if we take the swing low as downside, which is the ideal stop loss. 193% upside, 6 to 1 risk reward ratio. So this is really the trade, but we might not get filled on that one. It might not come down that low. So really, what do? You put your toes in the water right here, and then, you know, when we get down to this level, maybe we jump in. And then maybe even, 3 entries, and we get an even lower one than that off of the other 236. So, are we going to get filled on that lowest one? Probably not. But if we do, it's going to be by far the best fill. And then also we get a super tight stop loss on that one, in comparison. 16% stop loss, the same stop loss. And then still the same upside target would give us 264% upside, 16.5 to 1 risk reward ratio. So we want to get filled right here. Here's okay. Here's, yeah. But, I mean, it looks decent. Now, that's just a back test on the weekly and an overall bear trend. So let's look at the daily now and see if we're starting to turn this trend around. Oh yeah. 200 simple crosses below the 200 exponential. We're losing momentum to the downside. That's actually like pretty much the absolute bottom. At that point in time, we start rallying to the upside. You know, we basically hit the 200 exponential, get rejected, retest the 200 simple, chop around for a bit, break out, finding support for right now. So essentially what we're looking at is if we lose the 200 exponential on the daily, we're looking to buy the 200 simple. If we lose the 200 simple on the daily, we're looking to buy the 236 and the bottom of that channel. And if we lose, oh, sorry, I said that wrong. The first 236, and then the second one is the 236 in the bottom of the channel. Looks okay, though. I mean, honestly, it looks okay. So, momentum looks decent. Still on top of the slope line. It is blue. We're above the 0. Bunch of red histograms, but still looks okay. We see a buy, sell, buy at the top of the range. So, it's a bullish divergence signal in at 55. So, it's pretty much nothing to me. It's too high for like a useful bullish divergence signal. Yeah, but looks good. Looks good. Another nice one. Fucking you guys killing it today. All right, so that is STEMI check. LMT, Lockheed Martin Corporation. Okay, so obviously with everything going on and, you know, potential World War III, land war in Europe, potential war with China, like all this blah, 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 Iran, Iraq, whoever, you know, war in the metaverse, War of the Worlds, alien attacks. Like, there's a strong argument for, you know, U.S. defense stocks, okay? That being said, well, we'll just do what we do. Let's go out to the monthly here and take a look at what's going on here. Because this one is short term, it looks okay, but this is a big, big red flag for me. Fundamentally, again, you know, seems like a easy pick. I mean, you have to be crazy not to go after, you know, this type of stuff. When we're just like, I mean, we gave away like $100 billion in like awesome weapons to Ukraine. So, I mean, let's be real. Think we're going to refill those weapons? You think we're going to make more? Yeah, probably. Probably. So, where are we going to get them from? Well, probably Lockheed Martin. So, that being said, obviously, massive uptrend going back to the 90s. We did initially put in a low, and then after that, we put in nothing but higher highs and higher lows along the way. So very, very clear uptrend. So if we see if we can kind of get like a little bit of support around here and see if we see any kind of like useful resistance. Well, here we have a pretty clear channel to the upside from the bottom to the top. Heartline support. Falls short, but still new all-time high. All the way back to the bottom. Hanging out at the bottom. Heartline, 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 boom. And that takes us to where we're at right now. So, here's my problem with this chart. And what I don't like about Lockheed Martin. And, you know, full disclosure, this isn't the first time I've looked at Lockheed Martin. So, I'm not like discovering things as we go, like with some of the other charts. This one is already predetermined. So we put in this high right here in 2018. We put in a higher high right here in 2020. We put in a higher high right here in 2022. And when we look down here at the TDMACD, we have a high, we have a low, we have a lower high. Bearish divergence. Triple bearish divergence. Here we have a high, we have a lower high, we have a lower high again. Triple bearish divergence. Not cool. So triple bearish divergence on the monthly. So there's not a lot of charts in existence that have that. And full disclosure, Intel is one of them. And, you know, that's my obviously like favorite stock to make fun of and talk about how trashy it is. So, you know, Lockheed Martin, does it have some fundamentals? Could we go higher? Could we invalidate bearish divergence? Could, you know, are we likely to go to new all-time highs as there's essentially like, I mean, we're in a blue sky breakout, basically, you know, give or take like a couple months. Man, I just, triple bearish monthly divergence, I mean, could get so nasty. Like, but like so nasty, like, I mean, what is really going to happen? What, 44% to 50%? So it's like everything else already completely melted down. So it's like, oh, it's just going to do what everything else already did. I mean, it's down 10% off of its highs. So, yeah, holding up pretty good so far, but Damn, if that ain't a red flag, I don't know what is. Very, very bullish long term, but that monthly just tells us it just wants to melt down, it looks like. Not going to kill the trend, but, also, full on expect 25 to 50% drawdown is a possibility. So Lockheed Martin on the weekly, we see the 200 simple above the 200 exponential, crosses right here, consolidate for a while, put in a new all-time high. 200 simple is still on top. 200 exponential crosses up here, start looking okay again. We got the back test, came back up, 821 cross back to the upside again. Very little resistance above our heads. What we have to look out for though, this right here. All red histograms, lose the slope line, start to back test the slope line turns blue while we're underneath it. Well, we know what that is. We know what that is. That's number one bullshit. Most reliable rejection signal on this indicator. If we get rejected, maybe we just reclaim it and just go to the moon, and Lockheed Martin's just launching off missiles, and it's like, we don't even need fireworks. We're just going to launch actual like missiles into the air, and then we'll just make more, buy more, because we're printing money, and who cares? That is a full-on possibility. In which case, Lockheed Martin probably goes to the moon, everything else probably goes to the moon, and it's just, blue skies, rainbows, butterflies, all that good stuff. In reality, though, that's probably not going to happen. If we go to the daily, looks okay. It looks all right. But we're at resistance, barely off the lows. I would honestly just wait for new all-time highs and just buy into strength. I mean, we're 10% off the lows. So it seems like reckless to try to buy into resistance. And I imagine, honestly, without getting too crazy, it's probably yeah, exactly. It's the 618 fib. So it seems likely that we probably have already topped and we're just going to continue selling off. So essentially what I'd be looking for is just consistent lower highs and lower lows. And then if we start to break out of that and you want to add before the all-time highs, I can understand that, but buying right now just seems a little reckless, even though it does look okay. But I would wait for that breakout. At the minimum, I would wait for a break of this descending resistance. But honestly, I'm steering clear of this one. So I would recommend Raytheon instead. Obviously not financial advice nor a recommendation. I'm just saying if somebody was like, I'm buying Lockheed Martin, and I'm like, I'm buying Raytheon. And you'd be like, wait, why? And I'd be like, here's why. 200 simple cross above right here. Well, let's start at the monthly. We got 4 more to go, guys. Almost done. So new all-time highs again. We see a high, we see a higher high, we see a higher high. Here we see a high, we see a lower high, then we see a higher high. So we have invalidated that bearish divergence, which is good. Here we see no bearish divergence, which is good. So, if you're going to pick one of the ones in the space that are similar at least, do you pick the one with bearish divergence, triple on the monthly, or do you pick the one that doesn't? I would say doesn't. So hard sell, bunch of red histograms, likely to pull back right here. It looks a little tired on the monthly. I don't think now is a good time to buy. On the weekly, we have crossed down the 821. Looks okay here, but we probably are coming down here for a back test. Hard buy signal. Is that going to be a false signal? If we reclaim the 821, start closing back above like 95, we probably go to new all-time highs. But realistically, we're probably about to break down and retest 80. When we get to 80, that's going to look like an opportunity for a long, honestly. So, and what's that going to look like on our longer time frames? Or week. Let me look at this on the longer time frame really quick. If we're going by wicks, it looks like it broke down already from that key trend line. See, so again, the fundamentals are like, yeah, it's all about missiles and guns and woo, war, Liz Cheney. Obviously, Liz Cheney is a trash and I hate her. As much as you can hate someone that you don't know and have never met. But, warmongering in general, just not my cup of tea. So that being said, I think the wicks are the way to go. We have 1, 2, 3, 4, or just 3. And then we come down to it here and then we lose it. So maybe we push back up here, get rejected and roll over. Breaking down from this channel, or realistically, it's probably a little something more like this. It's probably just like an ascending wedge. Something along those lines. I mean, breaking down from this is like obviously, wait, what the hell? Damn, it's been a long stream, y'all. It's been a long stream, y'all. Yeah, not good. Looks like we rolled over. You really got to look for support down here. I don't really see a trade setup going on this one, but if I was going to go for something, it would probably be this. But we got to look for more retracement. So probably in the future, weapons manufacturers / warmongers are good, but not now. Not ideal at this moment, in my opinion. All right, so the last two, these are both, it's EDU and BDU, BEDU. They're Chinese education stocks. We were looking for this trade a long time ago, and then it looked like it was going to play out, and then it went to trash. So we exited, we re-entered here. We took profits on the, oh, do I not have it on this chart? Oh, sorry. So we took profits on part of our trade setup when we hit the 200 exponential. So we had a really, really nice move here to the upside, 126% already. I have kept open part of the position for now, probably more than I should. Here's why. What we were looking for previously was, and again, we'll go to the long-term time frame and break it down. I used to have this just like awesome, absolutely beautiful chart for this. And then they did the reverse split and it just went to shit. Like nothing lined up anymore or whatever. But essentially what happened was, you know, we went on a leg up, get a retracement, leg up, retracement, long leg up, and then break down. On the initial retracement from 2006, the initial pullback takes us like almost perfectly to the 618 on that. And then if we look at actually like from the bottom to the low right here, again, it takes us like perfectly to the 618. So either way you're looking at it, very technically to the 618. And then we see a pretty clear support line. And as soon as we break down from that support line, I mean, we basically capitulate. So obviously we want to avoid that. So once we capitulate, we hit the 618, and then what do? We start doing the exact same thing, all over again. So again, we see, I think if we go from the wicks, it's going to look a little clearer. So then again, we do the exact same thing. Just go on a long uptrend here. Every time we backtest, we take off. And then finally, we lose the trend right here. And then we melt down. And when we melt down, well, obviously we're not going to go from this swing to the high because we took that out. So what if we just look at this as like a whole entire macro retrace that's getting ready to take place? And when we do, we come down here to 618, consolidate, and that's what we were looking for, the 618 retrace, and then that gap fill, which actually I don't think I mentioned yet, but and then eventually it just starts to fail. We end up exiting. We re-enter at the 786 after losing the 618. That's our move that we already had. So before we came to 618, come back all the way up to the top of the range. Now, are we going to do that? Do we have to do that? Is there potential to do that? Sure. We don't know for sure, but hard buy signal, leaving the bearish control zone. Knife is above both of the stochastics. A bunch of green histograms in a row. Still red slope line, still below zero line. Reclaiming the 8. Next target would be the 21. So, is that why I stayed in part of the trade for now? Obviously the 0.5 would be a legit target, but the 382, the back test of the monthly 21, another 90% from where we're at right now. So, could get pretty juicy. And then if we go to the weekly, obviously we had the 821 cross to the upside, and that was at $15. Since then, we're up to 25. Again, nothing really changing here on the weekly. Momentum in our favor, looks strong, 821 crossing. Clearly in a bear market, which was confirmed right around when we broke down. And that's when we get this massive gap to the downside, which presents us with the daily. So here on the daily, obviously our take profit is the 200 exponential or the 0.5, which we got very close to. Normally I would exit at least a majority of my position there. But in this case, I'm actually looking for the potential of this gap fill now. Because here we literally gapped down from $58 to $25 when China basically said like, hey, we're going to regulate like education and everybody deserves equal education. Even if you want to pay more money to make your kids smarter, it's not fair to all the poor people. So all your kids are going to be dumb now, which is whatever. I mean, I get it. I get where you're coming from. But I mean, does it help China if just everybody is dumb? Or is it like better if just like the rich are smart and the poor are dumb? Or is there other way that you could like lift up the poor without, you know, smacking down the rich? I mean, I don't know. I mean, you know, by rich, I'm not talking about like rich as hell. I'm talking about like rich in the fact that you have enough money to invest in like your children's education, as opposed to just like private, like publicly. So that being said, we have a gap fill right here. We're at the gap. So we could very easily see a massive explosion to the upside up to like that $58 range. But in all reality, what do we want to do? We want to go from the high to the low on the Fibonacci, which, there we go. And we're just going to switch that one over to, let's go to yellow. Move that over a little bit. There we go. It's so pretty. All right, so we get the back test of the 382. Likely come back down to the 236. Find some support around like 18 bucks. And then we get to move up to the 0.5 or the 618 or something on it. 618 lines up perfectly with a gap fill too. So, I mean, the probability of us bursting to the upside at some point in time and filling that gap for 131% seems extremely high to me after what has taken place. Now, the real question is, though, obviously, if you're not in this trade setup already and you're wanting to participate, what are you looking for? You pretty much got to buy that 618 or the 236 pullback. So I'm going to put the trade setup at the 236, but it's not crazy to think you might want to have like one at the blue 618 and one at the yellow 236 so it doesn't run away from you. All right, and then obviously if we lose the 200 simple, if we lose the trend, the slope, we start closing, you know, longer term time frames, daily or whatever, below that level, we want to get out. If we come down to the 236 and hold, you know, that's fine. So that would be our one entry off the 618 and two off the 236. Can run a fairly tight stop loss here. We don't have to get crazy with it though. So let's just put it at 23% because our upside target is the 618 and there's no resistance on the way. So it's like, oh, maybe we go to the 0.5. And it's like, I mean, if we go to the 0.5, we're probably going to 618 because there's literally just air. It's an air pocket. So 222% upside, 23% downside, stop loss of $13.80. Bullish target of $58.25. Entry, $18.05. Risk reward ratio, 222% upside, 23% downside, 9.5 x risk reward ratio. Risk $1, 9.5 if you win, you lose 1 if you lose. So I like it. I like my odds. Earnings miss at resistance. It didn't just like crater. That's definitely a good sign. A lot of stuff has been like missing and it's like nobody cares because it's just already so beat down. So there's a lot of potential here to the upside. Obviously, the real trade though is if this actually just does what it did last time, which comes back up and revisits the previous high. And even then, if it gets rejected, like it did back here, which that's fine. That's okay. A high gets rejected, a high again. And then from 2014 to 2015, it's selling off. And then not till 2016. So basically 2 years if you didn't take profit at the previous all-time high of drawdown. And then eventually you go on a run. So let's just assume it does something similar. We get a move to 786, or let's just say we back test all the way back up to the previous high. That's a 980% upside with a target of $195. Oh, wait. No, $176? I can't see. Yeah, $176 upside with a target of $195. And then stop loss $13.80. 23% stop loss, 980% upside. Asymmetric returns, ladies and gentlemen. 41x risk reward ratio. 41 times risk reward ratio. So does that have to happen? No, it probably goes to 0. But we could take 41 other bets that go to 0. And if we're right on one of them, we break even. So, I mean, if we pick our 41 attempts correctly, we could crush it. All right, almost done. Last but not least, not as much to this one. It's not as beautiful as technical, but it's essentially just like a diversification in the same space. So maybe one overperforms, one underperforms, but why not put a little in each instead of just betting on one? So hard buy signal come out of the bearish control zone, very close to getting the cross hard buy signal, still well off of exiting the bearish control zone. We do have a lower low here, obviously have lower low on price action. This has done nothing but melt down basically since May 17th 2000, May 2017, and then it peaks out in October 2017, starts going down, and then obviously the China news just completely wrecks this. On the monthly, there's nothing really here. We backtested the 8 already, and we're just trending to the upside. Not really much we can get from that. If we go over to the weekly, though, we see, obviously we've been trending to the downside very bearishly, very, very bearishly. Now the 200 simple is below the 200 exponential. So we know what that means. Once the 200 simple crosses below, we're likely running out of acceleration, running out of steam, running out of momentum. Still melt down, still have a bloody waterfall. But, is this likely to be the bottom? Well, if the 200 simple is below the 200 exponential, it's way more likely to be the bottom than if the 200 exponential is still below. So we're very close right here to the 821 bull cross back to the upside. We have not had one of those since June of 2020, and it was immediately rejected. We did get one here as well. Very possible this crosses the upside, immediately gets rejected. We're at resistance. We already had a nice move off of 52 cents up to 86 cents. So we don't want to get too crazy with this one. But, we saw a pretty big spike in volume right here on the meltdown. We see a pretty big spike in volume right here, selling and buying. And then we actually close above the 200 exponential and simple on the weekly. It's going to look pretty good. And it's very close to 821. Now, we are starting to roll back over a little bit. The knife is elevated, but we have momentum in our favor. We have the buy, sell, buy perfectly spaced out on the weekly. Divergence, bullish divergence signal. So, again, it looks like it's trying to burst to the upside. And when we go to the daily right here, obviously we cross it here, and then we're about to be at resistance. Again, 200 simple is below the 200 exponential. So seems likely actually, that the bottom is, this is when it crossed over. So that was right around the bottom. Seems likely that the bottom is potentially in here. Now it has a reverse split coming up, 1 to 4 split, which means it's going to go from, 86 cents per share. It's going to 4x the price. But if you own 4 shares, it turns into 1. So it's the opposite of a split. Obviously, you guys all know that. But the potential upside here could be pretty good. So if we look at, now we don't have nearly as much awesome data to use. If we hit this 236, we confirm this is likely the swing low. And then at that point in time, we probably are headed to the 382. We have the 0.5, obviously right here. Clear interactions on the fib levels on the way down. So somebody was planning on this being the absolute bottom based on algorithms. I mean, you can see it right here. This is support. Descending triangle breaks down in a single candle. Support, 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 break down, back test, straight to the next fib. Consolidation, melts down to the next fib, and then melts down, back test, breakdown. So that was before we had the fibs, obviously, to see. So now in hindsight, looking back at it, we can see, how much there is. So a retest at 236 seems likely. Now, how are we going to trade this? Now, if we look at, obviously, it's well off the lows right now. 52% upside to the 236, which seems very likely now. And then obviously to the downside, 40%. So it's basically a 1-to-1 risk reward ratio. If we say hey, a new low or, the 236. But if we hit the 236, realistically, we're likely going to at least the 382, if not the 0.5. Now, we don't want to factor that in to our trade setups necessarily, but we have this nice little swing right here. And then obviously we have close to the 821 cross to the upside. So we're just going to switch over really quick. If we can kind of get a little resistance meltdown right here. I don't love this right here, but we have a pretty clear resistance, and then that's kind of acting as resistance right now. Now, arguably though, the acceleration occurred here. So it was back test, this is resistance now, and then we get to it, we break through, and then we test the next one. So this is obviously irrelevant right now, but we see that it's kind of corresponding with the breakdown of resistance. So seems very likely that we could get a nice trade setup out of this on a shorter time frame. I will have to switch over to the daily in a second. what it looks like we're going to be able to get something along these lines. All right, so obviously this was our previous little swing right here at 70 cents. We'll call it 69, 69.98. Round it down, 69. That's great. Fucking great. All right, so 69 would be the stop loss. The entry would be right where we're at right now, 86. 19% downside. We know the target to the upside is obviously going to be our various fibs. If we get to only the 236, it would be 50% upside, 2.5 to 1 risk reward ratio. But really, we're playing this for at least a retest of the 382, if not the 0.5 or the 618. So at the 382 trade setup, 173% upside, 19% downside. That's all right. So it's okay. 9 to 1 risk reward ratio. And then the 0.5. 337% upside with a target of the 0.5 at $3.75. Risk reward ratio 17.2, 17x risk reward ratio, 19.6 stop loss. Absolutely beautiful. Obviously, that is very nice and decent probability of success if we start to build up some of this momentum. And then obviously, last but not least, the most important, the piece de la resistance. 600% upside. That's that education nut, that moonshot. $6 upside target. Obviously, all these numbers are going to change once the reverse split, but we get the point. $3.75, or I'm sorry, $6 upside target for a 602%. What? 20% stop loss. That same one at 69 cents round down. And then, of course, our risk reward ratio, 30x. 30 to 1 risk reward ratio. Bet $1. If you're right, you get 30. If you're wrong, you lose $1. Brap. That's a wrap. Nice stream. We just broke the all-time personal record, and not necessarily one that I wanted to break or intended to break, of the longest stream ever in existence. So if you made it to the end, you are absolute fucking savage. You, my friend, are dedicated, okay? And for that, you get rewarded with some of the best trade setups I've ever seen all day today on this channel. And actually, like, really good trade setups, even though I kind of downplayed it there. So, all right, but we did it. We made it to the end. Appreciate everybody that showed up today. Thank you guys for smashing up the like button, subscribing. If you're not a group member, you're not here right now, so I don't have to worry about you. This stream is only for group members. It's 100% private, but we open it up to the public, so anybody can enjoy it. But obviously, all this is brought to you by the group members, who I appreciate very much, who also put in some phenomenal asset requests today. So congratulations. You guys have been absolutely crushing it. Love hearing about all the gains, all of the success you guys have been having lately. Loving the mojo. Obviously, you know, a lot less people participating on a regular basis, which I don't blame them. Market's not nearly as fun when everything's in a bear market going down. But you know who really gets rewarded are the people that keep paying attention in the bear market, because you know, that's where the real money is made. When you bought in a bear market, that's the real money. And we have presented today, you know, I mean, half a dozen phenomenal trade setups. And that doesn't even count like some of the ongoing ones, like the potential pot stock ones, the metals, and then all the other stuff. So definitely some serious potential here. I don't know how many people have, you know, had a, you know, 10x, 20x, 50x on a position, but I'm going to tell you the truth. Feels pretty good. Feels pretty good. So that being said, going to go ahead and wrap it up there. Key piece of data. We have still 3 Fed meetings this year. The next one is obviously in September. We have August off. And then we have one in November, one in December. And then obviously we looked at the Fed target rate for the Fed funds rate or effective rate, you know, projections. 3 Fed meetings left. Projected to have at least another 1.25% or 125 basis points. So are we going to get 75, 50, 0, 75, 0, 50? Are we going to get 75, 25, 25? Are we going to get 50, 50, 25? Are we going to get, you know, 50, 25, 50? I mean, I don't know. But some form of those that's likely going to get us at least up to that Fed funds rate target average. And if we end up in the top of the range, the higher end of the range, we're talking about like 75, 75, 50 or something like that. So I don't think that's likely right now based on the data we have. But looking at that CPI data, the sticky data from the beginning of the stream, I wouldn't put it by that we're going to see some disgustingly sticky inflation. Matter of fact, that's my base case at this point in time. So, and that's fully fine to adjust, because you guys know a couple years ago when all this was going down, I thought we were going to get temporary inflation followed by deflation, followed by more inflation, and then a forever struggle between inflation and deflation long term. Instead, we got inflation, and then the Fed and the government started making some poor decisions, at which point in time it was like, okay, this inflation is going to get sticky, it's going to stay sticky, and it has gotten absolutely nastier than I ever thought it was. I never in a million years, when I said we were about to get inflation and was betting on short-term inflation, I never thought it was going to get this bad or go this long. But the truth is, it was easy to see along the way as everybody was just making poor decision after poor decision after poor decision. So it's no surprise. And that's okay. It's okay to be wrong as long as you can admit it, move on, adjust, and figure out how the hell you're going to make money off of it. So that being said, appreciate everybody tuning in today. Obviously, none of this is financial advice. I'm not your financial advisor. Markets are extremely volatile. Please do your own research and trade responsibly. It is 12:12 a.m. Eastern Standard Time on 8/11/2022. This is the first time we had a multi-day stream, so congratulations everybody for the 2-day epic epic 2-day stream. But yeah, that's it for today. Appreciate you guys. Hopefully you got something out of this. Obviously, the longer this rally goes on for, the less probability we have of these trade setups playing out, because the good ones have already popped off. So we don't want to get reckless here. We've got to keep in mind that we're still in a very clearly a bear market. And until the Fed pivots, until inflation comes down, until rates come down, until the DXY weakens, it's going to be very, very hard for anything to go on any form of sustained rally, like, that it has those as crosswinds or headwinds, etc. So, all right, so that's it for today. Everybody have a wonderful evening. Thank you all for tuning in. I am, of course, Crypto Trend Trader, and this is it's Thursday wrap up, or midweek at this point, our midweek market update on Wednesday, 8/11/2022. But that's it. Everybody have a great night. Appreciate y'all tuning in. Thank you for the requests. You guys killed it. Thank you for all the group members and your support. Crypto Trend Trader, and I'm out. Peace.